I don't know what it is, but you know, the agricultural region here, and this is the climate change debate, and we really felt it in Marrakesh of coming north here into Spain and across over to Greece, and then of course over to the shores of Turkey as well. Wolfgang Prossel here, Lagarde's, here is the president of the European Central Bank, Christine Lagarde, still making introductions.
Online, and if you ask questions, please turn on your camera and the microphone. And with that, I hand over to President Lagarde, please.
Thank you and good afternoon to all of you. The Vice President and I welcome you to our press conference, and I would like to begin by thanking Governor Stournaras for his kind hospitality and express our special gratitude to his staff for the excellent organization of today's meeting of the Governing Council. The Governing Council today decided to keep the three key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. At the same time, inflation dropped markedly in September, including due to strong base effects, and most measures of underlying inflation have continued to ease. Our past interest rate increases continue to be transmitted forcefully into financing conditions. This is increasingly dampening demand and thereby helps push down inflation. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that the key ECB interest rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy remains weak. Recent information suggests that manufacturing output has continued to fall. Subdued foreign demand and tighter financing conditions are increasingly weighing on investment and consumer spending. The services sector is also weakening further. This is mainly because weaker industrial activity is spilling over to other sectors, the impetus from reopening effects is fading, and the impact of higher interest rates is broadening. The economy is likely to remain weak for the remainder of this year. But as inflation falls further, household real incomes recover, and the demand for euro area exports picks up, the economy should strengthen over the coming years. Economic activity has so far been supported by the strength of the labor market. The unemployment rate stood at a historical low of 6.4% in August. At the same time, there are signs that the labor market is weakening. Fewer new jobs are being created, including in services, consistent with the cooling economy gradually feeding through to employment. As the energy crisis fades, governments should continue to roll back the related support measures. This is essential to avoid driving up medium-term inflationary pressures, which would otherwise call for even tighter monetary policy. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Structural reforms and investments to enhance the euro area's supply capacity, which would be supported by the full implementation of the Next Generation EU programme, can help reduce price pressures in the medium term while supporting the green and digital transition. To that end, the reform of the EU's economic governance framework should be concluded before the end of this year, and progress towards capital market union and the completion of banking union should be accelerated. Turning to inflation. Inflation dropped to 4.3% in September, almost a full percentage point lower than its August level. In the near term, it is likely to come down further as the sharp price increases in energy and food recorded in autumn 2022 will drop out of the yearly rates. September's decline was broad-based. Food price inflation slowed again, although it remains high by historical standards. In annual terms, energy prices fell by 4.6%, but most recently have risen again and become less predictable in view of the new geopolitical tensions. Inflation, excluding energy and food, dropped to 4.5% in September from 5.3% in August. This fall was supported by improving supply conditions, the pass-through of previous declines in energy prices, and the impact of tighter monetary policy on demand and corporate pricing power. Goods and services inflation rates fell substantially to 4.1% and 4.7% respectively, with services inflation also being pulled down by pronounced base effects. Price pressures in tourism and travel appear to be moderating. Most measures of underlying inflation continue to decline. At the same time, domestic price pressures are still strong, reflecting also the growing importance of rising wages. Measures of longer-term inflation expectations mostly stand around 2%. Nonetheless, some indicators remain elevated and need to be monitored closely. Let's turn to the risk assessment. The risks to economic growth remain tilted to the downside. Growth could be lower if effects of monetary policy turn out stronger than expected. A weaker world economy would also weigh on growth. Russia's unjustified war against Ukraine and the tragic conflict triggered by the terrorist attacks on Israel are key sources of geopolitical risk. This may result in firms and households becoming less confident and more uncertain about the future and dampen growth further. Conversely, growth could be higher than expected if the still resilient labor market and rising real incomes mean that people and businesses become more confident and spend more, or the world economy grows more strongly than expected. Upside risks to inflation could come from higher energy and food costs. The heightened geopolitical tensions could drive up energy prices in the near term, while making the medium-term outlook more uncertain. Extreme weather and the unfolding climate crisis more broadly could push food prices up by more than expected. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation higher, including over the medium term. By contrast, weaker demand, for example, owing to a stronger transmission of monetary policy or a worsening of the economic environment in the rest of the world amid greater geopolitical risks, would ease price pressures especially over the medium term. Looking at the financial and monetary conditions now. Longer-term interest rates have risen markedly since our last meeting, respectively. Higher borrowing rates with the associated cuts in investment plans and house purchases led to a further sharp drop in credit demand in the third quarter, as reported in our latest bank lending survey. Moreover, credit standards for loans to firms and households tightened further. Banks are becoming more concerned about the risks faced by their customers and are less willing to take on risks themselves. Against this background, credit dynamics have weakened further. The annual growth rate of loans to firms has dropped sharply from 2.2% in July to 0.7% in August and 0.2% in September. Loans to households remain subdued, with the growth rate slowing to 1% in August and 0.8% in September. Amid weak lending and the reduction in the Eurosystem balance sheet, the annual growth rate of M3 fell to -1.3% in August, lowest level recorded since the start of the euro, and still stood at -1.2% in September. So, in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. At the same time, inflation dropped markedly in September, including due to strong base effects, and most measures of underlying inflation have continued to ease. Our past interest rate increases continue to be transmitted forcefully into financing conditions. This is increasingly dampening demand and thereby helps push down inflation. We are determined to ensure that inflation returns to our 2% medium-term targets in a timely manner. Based on our current assessment, we consider that rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB rates will be set at sufficiently restrictive levels for as long as necessary to ensure such a timely return. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Lefteris Papadimos of Reuters. Lefteris, please.
Hi, President Lagarde, what role did the recent weak economic data and the war in Gaza play in today's discussion? And secondly, did you discuss or at least begin talking about ending PPP reinvestment earlier or raising banks' reserve requirements?
Thank you very much, and let me take the opportunity of this first question to really express our appreciation for the extraordinary hospitality that the Greek National Bank, but also the Greek people that we have met here and there, have really deployed on the occasion of this visit. It has been a stellar organization and a tribute to the capacity of Greece in general to organize things and to make us feel welcome. So, Ekaristo. You asked me, I will start with your two last questions because in a way they are the most easy ones. Neither of these two questions, nor the PEP, nor the remuneration of required reserve, have been discussed at this meeting. You asked me about the current geopolitical environment and how that has weighed on our decision. I think we repeat 2 or 3 times in the context of this monetary policy statement the risks posed by the geopolitical environment and these aggravated risks as we see them unfold and develop. And of course, you have a special sentence in the MPS that refers specifically, in addition to the totally unjustified war of Russia against Ukraine, which refers to the tragic development as a result of the terrorist attack on Israel. We are monitoring the situation. We are very attentive to the economic consequences that that could have, whether in terms of direct or indirect impact on energy prices or the level of confidence that economic actors will continue to display. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you, Madame Lagarde. I have 2 questions. I think on many people's mind is the question, how long is actually sufficiently long, and what will make you rethink and perhaps cut rates at one point in time? Is it at 2% inflation? Is it at 2.5? Is it at 3? I think that is something the market is interested in. And then my second question goes on your comments about the yields, which are on the rise as well in the euro area, and you said from other jurisdictions or from other regions, you're probably referring to the United States. So are you concerned about that rise in yields as well, and also about the potential fragmentation here? Thank you.
Thank you very much for your 3 questions, if I counted right. Huh? So how long is sufficiently long? You know, obviously we refer to timely manner, sufficiently long. But in the same breath, I say we shall be data dependent. And at this point of our fight against inflation, and after 10 successive hikes, now is not the time for forward guidance. Now is the time to really stick to our data dependency knitting, if I may say, and we shall do so. We have acknowledged on the occasion of this meeting that our assessment is confirmed, the assessment that we had in September. All numbers, if anything, have reinforced our assessment of the situation. We have applied the 3 criteria that you all know well, the inflation outlook, duly informed by any information that we have, the underlying inflation in all its compositions, and the strength of the transmission of monetary policy. So we will continue to be data dependent. Your second question was essentially when and at what level do you cut? This was not discussed at all, and the debate would be absolutely premature. You know, we have acknowledged in our review of the macroeconomic situation back in September and yet again this time around, and we all know, and you know, that labor cost, wages, profit units, the analysis of that is critically important to determine the inflation outlook. And we will continue to accumulate data. On labor, for instance, we are going to have a wealth of numbers and data and intelligence when collective bargaining agreement and annual negotiations in 24 will be completed. That is way into 24. That's only a for instance. And, you know, even having a discussion on cut is totally premature. For the moment, what we're saying is that we have to be steady, we have to hold. This is the decision of today. We are holding. Okay, so your third question had to do with this sort of external tightening, which is not directly relevant to the fundamentals of the euro area economy, but which are tightening element nonetheless. because they directly impact on how long-term yields and long-term rates as well. So that definitely is a spillover that we take into account, and that is compounded with other elements that clearly are bringing inflation down.
Thank you, President Lagarde. And the next question goes to Alex Weber of Bloomberg News. Alex, please.
Good afternoon. Thank you for taking my question. You said that you're seeing strong transmission of your past rate increases to financing conditions. Can you say how much of the impact has yet to hit the real economy and then on inflation? And then secondly, a follow-up on energy costs. I'm trying to understand how you would react to another spike in energy costs for example, as a result of conflict in the Middle East. Would you take the recent inflation episode as a lesson and immediately react to that, or could you afford to wait for second round effects?
Thank you. Those are interesting questions. I'll start with your second one, which is essentially, have we learned anything from the last energy crisis, the impact it has on inflation directly and indirectly, and would we apply the same approach? This is work that is ongoing and that we will continue to do. But it's clear to us that it applies to a completely different economy today, and an economy which has had an episode of very high inflation, an economy where the interest rates is at a very high level of 4%, and an economy that has strong employment and which is weakening. So we have to take all these factors into account to see how possible higher cost of energy would actually affect both GDP and inflation. And it's in the context of that assessment that we would respond accordingly. But be under no doubt, our determination is intact, and our determination to bring inflation to 2% in the medium term is absolutely the same, if not reinforced by the proximity of the destination. Your first question was the... Oh, yeah, of course. So what we are seeing is a very strong transmission of our monetary policy in the banking sector in particular. And the financing of the economy as a result is directly affected, which in turn plays onto the reduction of inflation and the dampening of demand. And those numbers are really, you have seen the bank lending survey, I'm sure, and they are very striking in terms of both volume and rate transmission. We know that there is still more to come. So as is often the case with monetary policy, there is this transmission lag time. The assessment by our staff is that there is still more in the pipeline and more to come to affect the real economy. And the assumption is that it will continue to unfold throughout the end of 23 and first quarter of 24. Now, one might argue that it's going to last longer, but we have already seen a significant transmission to the financing conditions. More is to come. And if you look at, for instance, the housing sector, it's pretty obvious that there is transmission to the real economy. If you look at the volume of capital expenditure, of investment by corporates, there is a reduction. It's not just the banks telling us that they will be more attentive to the risk and that they are reducing their flow of credit. It's also the corporates that are putting a brake on their investment because of the level of interest rates. That clearly results from the various corporate telephone surveys that we conduct and from the bank lending survey as well. So both in the housing sector and in the investment numbers that we have, it is transmitting to the real economy.
Thank you. And the next question goes to Eleftheria Kvartali of the Greek website Capital GR.
Hello. President Lagarde, I would like to ask you a question on spread widening. Have you at all discussed spread widening, and especially the case of Italy? Italian spreads are now above 200 basis points, and I was wondering if this is a level the ECB is comfortable with, or it is considered to be a level of significant widening. And my second question is on Greece. Are Greek bonds now back to the ECB's normality? That is, are they now eligible for every purchase program when and if they are ever activated again? And are you confident that the Greek economy can return to normality? That is, where it was before the debt crisis, when it was rated A and A+ even? Thank you.
Thank you very much for your question, your two questions. Let me turn to Greece first and remind you that we only have one active purchase program that is operating at the moment, and that's the reinvestments that we conduct under the PEP. Under APP, we don't do any reinvestment anymore, so there is no question as to which country is eligible or not eligible. So Greece was eligible to PEP under a special waiver that had been decided at the time. Well, the good news is that the waiver is irrelevant. Greece does not need any waiver. The Greek instruments are eligible to PEP without any exceptions. So that's point number one. Point number two, Greece is now back to pre-COVID situation, and I speak under the control of my colleague and friend, Governor Stournaras, but Greece is actually higher than the level where it was just pre-COVID. And if I can, comparisons are odious, but I will make an exception. Greece compares extremely well with other countries. And I'm saying that because we're in Greece. I'm not going to, comment any further on who is better, because I don't want to comment on country-specific situation. I look at euro area numbers, but we are here in Greece. And Greece has demonstrated phenomenal recovery capacity, and it is, if I recall, 10% above the pre-COVID level at this point in time now. So I don't know what is normal or abnormal, but I have to say that it's a stellar performance. Would you like to add to this? And then I'll come back to your first question.
I fully agree, President, with what you have said. On activity, we're about 10% higher than the pre-COVID situation. The GDP growth is much higher than the average of the Eurozone. Spreads, they are within a range which we think it is quite normal. So all in all, it's a success story, as the President said in her press conference. But also, I do not deny that still there's a lot to be done until we get back to a rating of A+, as you said.
So on the first part of your intervention, let me remind you what we do. Our mission is price stability. We have defined it in our strategy review as 2%. We are not at 2%. The best tools that we can use to return inflation to 2% are our interest rates. And this is what we are using, and I just want to mention that the fact that we are holding doesn't mean to say that we will never hike again, okay? So at this point in time, on the basis of the data that we have, we are confident that the rates at 4%, well, I should say, the three rates at the level they are contribute substantially to bringing us back to 2% in a timely manner. But we are data dependent. Second point is that in addition to our stance, we also have to make sure that there is proper transmission of our monetary policy throughout the whole euro area and to all countries in the euro area. And we have all the adequate tools in order to make sure that that happens. Thank you.
Thank you, President Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you very much. President Lagarde, two questions from me. The first question is about central bank losses. So we've seen this week that the Riksbank, I know Sweden's not in the Eurozone, but the Riksbank has warned it will need 80 billion Swedish krona from the government to repair its balance sheet. Do you expect any Eurozone central banks to need similar kinds of capital injections? And the second one I'd like to ask is about PEP reinvestments. What's your view on the various calls we've heard from members of your governing council to say that those could be, the end of those reinvestments could be brought forward? Do you think that would be a risky move? Thank you.
Thank you very much for your two questions. So on your first question, I will not go into the specifics of each and every national central banks, because they are all in a different situation. Some of them are publicly quoted institutions, others are not, and there is no one-size-fits-all for the situation they're in. What I know is that as a Eurosystem and as ECB, we have one mission, which is price stability. And we do not have as a purpose to show profits or to cover losses. And it would be actually wrong if our decisions were guided by our P&L accounts rather than for pure monetary policy purposes in order to bring inflation back to 2% in the medium term. On your second point, as I said earlier, we have not discussed PEP on the occasion of this meeting. Thank you.
Thank you very much. And the next question goes to Silvia Berzoni of the Italian TV program Class CNBC. Silvia, please.
Good afternoon to all, President. Do you think that given the vigor of the monetary policy transmission and the added uncertainty of the war between Hamas and Israel that you just mentioned, ECB economic forecast might be a little too optimistic? Thank you very much.
Well, thank you so much for your question. I'm tempted to give you an appointment for our next monetary policy meeting, because obviously in December we will have a whole range of new projections, new numbers, and as is often the case, we revisit either up or down, depending on the situation. And once again, we're going to be purely data dependent. What we know for a fact is that growth has weakened. And if we look at PMI numbers, for instance, they are not indicative of a very vigorous growth, which is why I have clearly indicated in the monetary policy statement that growth continues to be weak.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. Just again, coming back on the bank lending survey, what you mentioned several times, the economy basically stagnates. I mean, is there a risk, are you worried that you've just been too far? Yes, the transmission will be slow, but you might have gone too far. And that's just one question, actually.
Yeah, it is one question.
Sorry.
No, that's okay. Well, I can only repeat what we say, and we actually repeat in the monetary policy statement, which is that we believe that the three rates where they are, if kept for a sufficiently long period of time, will actually make the contribution that is needed, the substantial contribution that is needed to return inflation to 2% in the medium term. And what we did on the occasion of this monetary policy meeting was to compare the September that we had in September when we made our decision, the new data that came in, including the inflation number, headline, and core inflation, including the bank lending survey, notably, and the various flash estimates and PMI numbers to confirm the assessment that we had previously. And let's not forget, our mission is to return inflation to 2% to make sure that inflation does not cut into purchasing power of people.
Thank you. And the next question goes to Leonidas Exotsidis of Handelsblatt here. Leonidas, please.
Good afternoon, thank you. I would like to come back to the rising bond yields again, please. There is the point of view that the rise in the bond yields helps the central bank in the transmission of the monetary policy as financial conditions become more tightened. On the other hand, there are also people arguing that it can become a risk for the financial stability. Do you agree with both points of view? And do you think it can become more difficult for you to find the right balance in the future? Thank you.
Thank you. I'm going to share your question with the Vice President because he's the real expert on this panel on financial stability. But I just want to, again, remind you of what I said about the rising bond yields. This is a movement that originated outside the euro area. It is not directly related to the fundamentals of the euro area, and it is different, but we are facing the same circumstances that we feared back in March at the time of the various regional banks and Silicon Valley banks and Signature and First Republic collapses, where again there was spillover and the fear of more of it. But this is something that clearly impacts our own rates, and we take that into account.
Good afternoon, everyone. Well, in a couple of weeks, we are going to release our financial stability review. The financial stability review, is the document where we indicate the main financial stability risks that we have here in the euro area. And I would say that the increases in yields is something that we are looking at very carefully. Why? Because the main risk that we have identified in the past, and I think will continue being identified in the near future, is very high valuations of different kind of assets. And we have seen that when you look at these valuations, not only financial assets, as the president indicated before, we refer as well to the real estate market. Well, the increase in yields can give rise to an important correction. So this is something that we are taking into consideration very, very closely. And simultaneously, other factors that, the higher yields can have an impact, mainly on the non-bank financial intermediaries. There we have seen that there is a concentration of potential vulnerabilities in terms of liquidity risks or liquidity mismatches, in terms of credit risk. And this kind of situations that you have an important and pervasive increase in yields can give rise to additional problems for this part of the financial system. That is not totally isolated from the rest of the financial system. It has important liaisons and links with the banks. So the increase in yields is something that we are considering very closely. And, we will make a lot of comments with respect, in our financial stability review about the potential impact that this might have in terms of financial stability.
Thank you, Vice President. The next question goes to Michalis Psilos of the Greek daily Naftemporiki. Michalis, please.
Thank you so much. Mrs. President, now that Greek bonds are eligible, as you said, would they be included in your APP portfolio? Should you pause QT and start reinvestments? That's for sure. And the second question, once upon a time, I would like to say the concept of saving was very important, but in most euro area, like in Greece, deposit rates are almost zero, and of course, well below from inflation, while lending rates have increased considerably. How do you comment on that, and what can be done to change this situation? Thank you.
Thank you very much for your two questions. On the first one, I'm tempted to tell you that I don't want to deal with hypotheticals. We are in a process of fighting inflation, of bringing it to 2%, using predominantly the interest rates and ancillary additional component that come as a complement, such as the gradual reduction of the balance sheet, as we have seen as a result of TLTRO reimbursement, as a result of non-reinvestment of APP. But I'm not going to, have hypotheticals about what if after tightening, blah, blah. Suffice to say that Greece is today eligible to the PEP without any waiver. So it's, pari passu. Everyone in the group, the 20 member states, are in the same situation from that perspective. You asked me about the rates and the obvious gap between the lending rates by banks to corporates and to households and the remuneration of deposits. Our job at the ECB and at national central banks is to set the rates at which banks and other institutions finance themselves. Our job is not to set the rates at which they lend. We hope that they transmit that properly because that's part of the transmission mechanism, nor the rate at which they remunerate deposits. And this is an issue that occurs in several euro area countries, to which solutions are brought by either the authorities or by the power of consumers themselves or by the competition authorities. But this is not an area where the ECB or the National Central Bank can actually take action.
Next question, Andres Stumpf of the Spanish daily Expansión. Here.
Thank you. Madam President, you're a few days away from finishing your the first half of your mandate. I was wondering if there's anything you regret from these 4 years, and also if there's something that makes you or have made you especially proud. And a second question, if I may. In Spain, the political parties are trying to form government, have proposed extending the new extraordinary bank taxes. And when the tax was announced, the ECB published an opinion advising against it. Should we expect another opinion, or have you got anything to say about this topic at all? Thank you.
Thank you for your personal question, and rest assured that I have no regret, okay? I'm not going to sing it to you, but there is a famous French singer that has done that much better than I could ever do it. So no regret. You know what happened today? One of our members, after 12 years of loyal and good services, finished his term on the Governing Council, and it was his farewell Governing Council meeting. The level of warmth, of emotion, of acknowledgement that was demonstrated to him, and his response, reminded all of us around the table that sometimes we disagree. By the way, we had a unanimous decision on this occasion, just in case any of you is interested. Thank you. So while we disagree on occasions, because there is this common drive for delivering on the mission, we have a quality of debates, of exchanges, of different views. We try to convince each other on occasions, and we sometimes manage. That is something that is to be cherished. And in a world where, for dissenting opinions, people go into totally unconsensual and unrational directions, it's a gem. So that's for my personal take. I will not get personal again. That was it. So on the tax, maybe my Vice President.
Our assessment about bank taxes is well known. We have always said that this kind of levies, this kind of taxes should not impair lending, should not impair credit growth, and should not damage the solvency of the banks. That was the recipe that included in our opinions for taxes that were approved in the case of Lithuania, Spain, and Italy. Well, in the case of Italy, we had different versions, no? And the final one, I have to say that it was more reasonable, no, in that terms, because they indicated that if they increase the capital buffers, then the tax will be reduced. So this is the approach. So I don't know whether what's going to happen, with the Spanish case, whether it's going to be extended or not. So let's see. But the principles of our assessment with respect to this kind of taxation is quite clear.
Thank you, Vice President. And the last question today goes to Klaus Rainer Jakisch of ARD Television. Klaus Rainer, please.
Good afternoon. Thank you very much for taking my questions. Mrs. President, some people speculate that we've seen the height or the peak of the current interest cycle. Can we interpret this from today's decision?
Sorry, the peak of what?
Of the interest cycles. Can we interpret this from today's meeting, or is still everything open? And the second question you have already answered partly. Can you give us a little bit of insight of the debate today? From the protocols of last meeting, one can get a bit the impression that the differences between the different groups of the governing council may have perhaps be a bit stronger than in the past. Is this interpretation right? Thank you.
Typically when you reach by unanimous consent a decision, you don't have a widening of the differences. And, together with colleagues who have been participating in all these hours of discussions here in Athens, I can assure you that there was a general, well-shared assessment of the current situation, the judgment that we have made, and the monetary policy decision that we took, which after 10 different hikes over the last 15 months is for the first time a hold. So it's, sometimes inaction is action. And a decision to hold is actually meaningful and was taken by total agreement of all governors and members of the Governing Council this morning. So if any of you wanted to add to that, but I think you have either misinterpretation or strange information from inside our discussion. We were inside the rooms, and I can assure you that it was strong. Do you want to add something, Yanis?
No, I fully agree with what you said. It was a unanimous decision.
And as to your question on peak, I'm not going to pass a judgment to say that we are at peak. We are data dependent. And we are going to, meeting after meeting after meeting, assess on the basis of the 3 criteria of the inflation outlook, of the underlying inflation, and the strength of our monetary policy transmission, whether or not our interest rates are delivering sufficiently in order to help us reach the 2% medium-term inflation. Thank you very much.
Thank you. That's all for today from Athens. Next time is the 14th of December in Frankfurt. Until then,
this is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. We have been listening to the press conference with Madame Christine Lagarde, which seems to be taken as a dovish pause, most broadly by analysts. In markets, you could see that she has declared victory when it comes to delivering a press conference that didn't rock the boat too much. Things basically where they were pre-trading session. You could see the S&P down just about 0.2% less than that. NASDAQ down similarly, climbing back from some of the losses from earlier. The euro really was what I was watching throughout all of this. And what you could see is a bit of stasis there, still at that 105 handle as people parse through all of this. Yields marginally lower. The message seemed to be, frankly, consistently that we're not necessarily at the peak, but the market was saying basically you are done. Outside of stocks, you can see broadly throughout the asset classes a feeling of pause, not just at the ECB, but also at central banks more broadly. You can see across the board 10-year yields, 30-year yields in Germany, in Italy, in the U.S., all lower on the day. I do want to get to President Lagarde speaking on some of the issues, in particular the latest ECB decision.
The Governing Council today decided to keep the three key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong.
Bloomberg's Maria Tadeo joining us now from Athens. Maria, was this essentially a dovish pause, because that's how it's being interpreted?
Look, I think there are many elements that you could argue and say, yes, it was. Because on the one hand, you look at the decision. Obviously, they decided to hold. It is significant because we had been looking at this very aggressive hiking cycle from the European Central Bank. Also, when you look at the details in that statement, she said that there was no meaningful discussion around the PEP reinvestment. Remember, some had suggested that maybe they could bring it forward. As it stands, it should run until the end of 2024. There was no changes to that. She was also asked a number of times, what about the assessment of the overall economy, and pointed to the downside risk. She also said, as you noted, not a victory on inflation, but she did say the monetary policy is working, the transmission is working, but also it will intensify. She talked about Q1 of 2024. A lot of this, you put it together, you could say, yes, it was not just a hold, but a dovish one from the European Central Bank. There were a number of comments, however, that she made that you could argue should try to balance it out, but to me, they felt a little bit off script, where she said the fact that we're not hiking today doesn't mean we're not going to hike in the future again. She also said, I'm not going to tell you where the peak is, but obviously, as some would say, it would be unwise for the European Central Bank to do that. But to me, it really did feel a central bank that is now turning the page into fully this debate of higher for longer. So this is not a question anymore about how many more hikes, but how do you sustain it and for how long? And that will be, I presume, the fundamental question. What is restrictive enough? It seems to be as it stands, but how long restrictive enough will be the question for the European Central Bank going forward.
Maria, great work as always. Maria Tadeo, thank you so much joining us from Athens. Joining us now to try to parse through what lower, higher for longer really means and whether this sets the tone for next week's Fed meeting is Invesco's Alessio De Longis and Winnie Caesar of Credit Sites. Alessio, I want to start with you. What was your takeaway from the press conference?
My takeaway is that this was absolutely the right decision. I do share the importance of looking at the information from the bank lending service, and they're clearly transmitting that information, that monetary transmission is in place, and is probably even stronger than was initially anticipated. Loan growth, credit demand is coming in well below what was expected 3 months ago. So the pause, higher for longer, and the wait and see approach is the right one. What will be at the end of this wait and see approach? I think ultimately we'll find ourselves sometime in late 2024 contemplating or already delivering rate cuts, and it will be probably driven by inflation surprising to the downside and coming in below below the 2% target in the 2 years projections.
And that seemed to be what she was trying to avoid talking about, saying that that was not the case whatsoever. Winnie, your take on how much the ECB just set the tone for the Fed next week versus a completely different economic backdrop with very different concerns?
That's a great question, Lisa, and thanks so much for having me this morning. We have expected that the Fed is going to hold at its next meeting, but maintain a very hawkish narrative, which I think would be a bit different than what we just saw with Lagarde at the press conference for the ECB. The economic data in the U.S. has been quite resilient as of late. We've seen a very strong Q3 GDP print, along with some durable goods and initial jobless claims that came in a little bit better than expected. Now, there is something for everyone with some of the pricing data, and we do have the PCE read tomorrow for September, which will be quite important as well. But we do think that we'll have a more hawkish hold from the Fed next week.
And that's definitely something that will be slightly different, at least in tone, versus what we just saw. Alessio, just sort of wrapping together all of the things that Christine Lagarde was talking about, a lot of people mentioning it seemed like she was more concerned about growth than she was about inflation, and it felt like they were confident they had inflation under control. Is that an accurate assessment?
Definitely the emphasis was more on growth, and growth is what has been surprising to the downside. I mean, European growth is at recessionary levels. It was true in Q3, is probably that's correct also in Q4. However, when you look at the behavior of cyclical variables such as the manufacturing surveys, consumer sentiment surveys, earnings revisions, we are at those cyclical troughs. From here to get worse, we need to get into basically conditions that were more consistent with 2008 or COVID type of recessions, which we don't see in the cards. So from a go-forward perspective, and again, markets are driven more by the rate of change rather than the level of economic activity, we see actually potential for a cyclical rebound, and we wouldn't be surprised if growth were to surprise to the upside relative to current expectations over the next 6 months.
Interesting. Meanwhile, things surprising to the upside, that would be the U.S. Winnie was talking about this. We got GDP out of the U.S. showing the economy growing the fastest in 2 years last quarter. Bloomberg's Michael McKee joining us now with more. Mike, I have to tell you, the reaction in markets was really surprising to me. I expected a pop in yields. I expected to have some sort of bullishness born through in the idea of what does this mean for longer-term inflation? Exactly the opposite.
Well, it may be that what Alessio is saying is not the way the market's taking it, that the market is thinking we may see some weaker growth going forward. A lot of people don't think we can sustain this. 4.9% for the third quarter, led by personal consumption up 4%. Now, can Americans keep spending at that rate? Most economists don't seem to think so, although Winnie makes a good point. We do get PCE numbers tomorrow on spending. Here's the real disappointment, though. Business investment down 0.1%. It was up 7.4% the prior quarter. So businesses dropped out. Do they come back? These are questions that are going to consume people going forward, trying to figure out what happens in the fourth quarter. Other numbers today that we talked about, jobless claims up 210,000, still not sending us any signal. Trade balance a little bit deeper, but it does suggest something that came off of GDP a little bit. Durable goods orders, are we seeing a rebound? 4.7% on the headline, 0.6 on the core sort of capital goods orders. And then here, I want to go one more time, Lisa, into this idea of what happened with business spending. If you take a look at the ECAN function on Bloomberg, which is a terrific economic model, it shows you the last 3 quarters and what we have seen. Yellow is the color of business investment, and look at the change. You can see blue, that's what consumer spending is, and obviously it got bigger, but that yellow line is almost non-existent. What happened to business spending, and does it rebound? And do we get some kind of revision going forward that shows it higher?
Michael McKee, thank you so much. Alessio DeLongis and Winnie Caesar are still with us. Winnie, your thoughts on that business investment and how important that is to sustain the kind of growth that we've seen?
I think that it's really important that businesses start to feel a bit more confident about the outlook for 2024. Clearly, the consumer has been doing a lot of the heavy lifting as of late, especially in that Q3 print. And there are a number of headwinds facing the consumer, especially in those lower income tiers where inflation has been the most challenging. Now, we do have a pretty strong labor market, which is going to underpin a certain baseline level of spending for the consumer. But we do expect some deceleration there heading into 2024, which means that businesses are going to have to start to have a bit more of a constructive outlook, which is really challenging when you have volatility, higher borrowing costs, tighter lending conditions, and just a lot of uncertainty around what does 2024 look like relative to this year.
Alessio, what's the most important data coming up for you?
Maybe not data coming out, but I continue to be fascinated by the rise in long-term real yields, and in the context of that, how the employment picture continues to be very resilient. There is so much focus on technical supply issues that are affecting bond yields, and that's all true, that's all correct, but ultimately the clearing price is what the market is giving us. And higher real rates in the long end of the curve, which was completely unexpected by ourselves as well 1 or 2 years ago, is showing that the economy has much more resiliency than was initially anticipated. The economy can sustain As of today, these real rates, the unemployment rate is still at all-time lows almost globally. And I think it gives us food for thought in terms of our understanding of how resilient the economy can be in the face of tighter monetary conditions.
Alessio De Longus, Winnie Caesar, both of you, thank you so much for being with us. Coming up, big tech earnings continue missing the mark, but the actual data is pretty good. That conversation coming up next with Dan Ives of Wedbush.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Let's turn now to the equity markets. Big tech results off to a rough start, at least in trades, with Meta delivering the latest disappointment, the so-called Magnificent Seven, shedding more than $200 billion in market cap due to earnings and threatening to push the NASDAQ 100 into a correction territory. We want to continue that conversation with a long-standing tech bull, Dan Ives of Wedbush. Dan, we talk about the disappointments in the earnings, but when it comes to the likes of Meta, the disappointment was that they aren't sure how macroeconomic events are going to affect the bottom line. What's your take on the reaction in shares to some of the earnings that these companies have put up?
Yeah, I think hypersensitive. And in this nervous backdrop that we're seeing, we saw it with Google as well. But you look at the actual numbers, strong in terms of digital advertising growth. They're ramping up spending, and Meta's in a position of strength rather than weakness. So I think I think we're seeing overreactions in terms of specifically Google and Meta as well. And I think big cap tech, if you actually parse through earnings from cloud to digital advertising, it's strong. And I think that's something that's extremely important going into year end.
With Meta, there also is a concern that the known item on their balance sheet was how much they plan to spend on endeavors that are unclear, whereas the unknown is how much revenue they're going to bring in. How much does that give you a bit of agita?
Yeah, look, I think the agita, if you go back 18 months ago, they were putting good money after bad in terms of metaverse. This is a different company. I mean, Zuckerberg's comeback kid for a reason here. They need to spend on AI. They are in a position of strength to monetize in the digital advertising side. And I think that's the right move. And even though you will see these knee-jerk reactions in this macro backdrop, I think overall, this is something I view as sort of short term. I think tech continues to rally into year end despite what we've seen here. Comes down to the fundamentals. I feel better about big tech post earnings than before, given what we've seen, especially from Redmond in the cloud.
What about, Redmond in the cloud is one thing. Google, though, was a sort of different story, and I'm wondering how concerned you are about the fact that they don't seem to be catching up, at least when it comes to market share, to their bigger peers.
Yeah, look, you don't like Michael Jordan because he's a baseball player. So, I mean, if you look at Google, you own it for digital advertising. That was actually better than expected. When I look at cloud, there's still probably 6 to 12 months from seeing an inflection point there, especially on the AI spend. I mean, obviously, when you compare it to sort of the golden, Redmond in terms of that cloud performance, does not look good. But I think that was another overreaction in terms of digital advertising strong and cloud. That's still a business that's massively accelerated over the last few years. I think that's why investors, we've been sort of hand-holding through these numbers. I think there's a buying weakness.
I love the idea of you going around the world, currently in Bangkok, holding the hands of investors and saying, just keep buying. There is a question, Dan, about what we're going to learn today after the bell when we get Amazon earnings. You talk about Google and how it's ultimately an ad spend kind of story. What story is the one of Amazon? Is it cloud? Is it their media business? Or is it the nuts and bolts of brown boxes?
Look, I think from a multiple and from what happens with the stock, it's about AWS, because that's really the golden goose in terms of that success that they're seeing on hyperscale. I think you're actually seeing the next stage of growth in terms of cloud. AI will clearly play into that as well. I think a rationalization on the e-commerce side. I think numbers finally set low enough. And I think Amazon's another. I think that finishes up this big tech week actually on a positive note, especially when you look at the fundamentals going into year end and going into next year. And that's why I believe tech stocks from here are up 15-20%.
You're in Asia right now, Dan. How receptive are Asian investors to the U.S. tech story to continue buying, to continue to invest?
Well, I think the theme here, and I've seen it throughout Asia, is they're selling Chinese tech and looking to buy U.S. tech. I mean, because that's where the trends are in terms of cloud, in terms of cybersecurity, and especially in terms of AI. And you don't have to worry about what's going to come out on a weekend, which is the issue with Beijing and regulatory. So I actually think there's a huge shift that's going on here. I'm seeing it firsthand. Where is the growth? It's U.S. tech.
Dan Ives, thank you so much for being with us. Wonderful, as always, to get your views. Enjoy your trip around Asia and currently in Bangkok. Right now in markets, you could see a bit of extension of that softness, particularly in the NASDAQ, now down 0.8%, more than the S&P. So despite some of the optimism we were just hearing there and the results, not necessarily hanging in there, the S&P lower by 0.4%. In the yield space, outside of stocks, it is interesting to see yields come in despite the fact that we got better than expected GDP data, the fastest growth in the third quarter in almost 2 years. Yet people focusing maybe on that the Fed, the ECB are done, maybe on the idea that there was a bit of softness in the labor market, a bit. We are not going to know until maybe later. This was Countdown to the Open. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that a small nation is forced to suicide.
Bloomberg, context changes everything. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to get a look at these markets with one Vince Signorella. He's going to limp his way into the Bloomberg Interactive Broker Studio and give us his market call. Plus, we're going to check in with Keith Naughton. He's a reporter for Bloomberg News in Detroit. I think we might have some movement with Ford.
We got an agreement.
So we got something. Now, hopefully that'll be the template for getting some more of those workers.
Well, you know what
back.
they're going to do? They're going to strike. They'll keep striking the others, but they're going to go back to work at Ford.
Yeah.
And that puts the pressure on the others.
Yep.
Oh, here comes Vince.
Yep.
He's got a Mao collar. What do you call that? A Mao collar?
I don't know. It's going on.
We'll
check in. We're going to have a lot more.
Tattoo.
We got a lot of stuff going on, but we'll break it all down as we come back. Let's kick this whole thing off with Nathan Hager.
All right, we got some new economic data coming in as well. More signs of strength, this time in the housing market. Previously owned home sales unexpectedly rose in September, up 1.1%. Economists surveyed by Bloomberg were expecting a 2% decline. Levels are still at the lowest on record, though, with affordability constraints, high borrowing costs, keeping demand limited. But we did get that surge as well in third quarter GDP, 4.9%. Biggest jump in more than 2 years. But count Bannockburn chief market strategist Mark Chandler among those who say the Fed is probably going to look past the latest strong data.
When I look back at the September summary of economic projections by the Fed, they had the economy growing a little bit more than 2% this year. Voila, that's what we've done in the first 3 quarters of the year. So I think that the real key going forward for all kinds of investors and businesses is what happens in Q4. The market is saying there's going to be a dramatic slowdown.
And we check the markets for you all day long here on Bloomberg. Right now, the S&P 500 is lower by 0.7%, down 30 points. 4157 is the S&P level. Dow Jones Industrial Average now moving lower, down 0.25% or 83 points to 32,953. The NASDAQ leading the decline, session low down 1.1%, down 140 points, 12,680. Still a lot of focus on Meta Platforms. Disappointing outlook for advertising growth. Meta Platform shares are down 6.2%. 10-year Treasury is up 8/30 seconds. The yield is down to 4.91%. Two-year yield 5.06%. That's a drop of 6 basis points. NYMEX crude is down 1.6%, down $1.42 at $83.95 per barrel. COMEX gold down 0.4%, down $7.20, 1987.90 per ounce. The euro 1.0535 against the dollar. The yen is at 150.32. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so go check that out. Want to highlight, coming up at 10:30 a.m. Wall Street time, a simulcast, Shonali Basak going to interview Morgan Stanley CEO James Gorman and CEO-to-be Ted Pick. So be around for that. Big change in the leadership of our good friends over at Morgan Stanley. That's 10:30 a.m. Wall Street time. We've got kind of red on the screen here. S&P off about 0.6%. Lots of earnings out there. Let's break it all down with Bloomberg Markets reporter Bailey Lipschultz. Bailey, what are you looking at?
Yeah, a lot of red. NASDAQ 100 now down 10%.
For weeks, by the way. I mean, there was one up day, right?
Yeah,
like
one up day.
Tuesday. And other than that, the last 2 weeks have been down.
And now NASDAQ's down 10% from the July 18th closing.
Oh, boy, folks. That's an official correction.
Get ready for the red headline this evening. Weakness, though, really across the board. Meta down 5.9%. Strong 3Q results, talking down expectations for fourth quarter, talking down expectations and lack of clarity for 2024. So that's among your biggest drags to the downside on the S&P 500. Worst performer, Align Technology, ticker ALGN, makes Invisalign down 22%, missing expectations. Analysts across Wall Street slashing price targets, talking down the outlook. This is still a company that's worth more than $15 billion, but just a shell of itself from
my 19-year-old son recently pitched me on doing that Invisalign thing. Yeah. I shot him down. You know why?
Oh, really?
Because we did the braces back when he was 13 or 14, and he did not do the, what do you do after that?
The retainer?
The retainer. Did not do the retainer. I said, dude, you know, I pay once for these things.
One shot.
One shot.
That's what my parents said.
Yep.
Same thing. But luckily, I have not had the teeth move.
But it's a thing. I mean, it's a thing. I mean, it's an option.
Yeah. But how much is it? Like $3,000?
Yeah.
Mine, it's closer to $5,000.
Yeah.
$5,000.
I've actually had it done.
Oh, we have Vince Signorella already in the studio with his Mandarin collar and super straight teeth. Plus, he has a tattoo. I saw earlier. I walked by.
I do.
Really?
Yes.
Yeah. What's the tattoo?
It's it's Japanese, and it translates to "What's next."
And where is this tattoo?
On my arm. Well, I mean, it wouldn't be on my butt if you saw it when he walked past my desk, would it?
That's a very good point. That's a very good point.
Bailey, give us something else here in these markets.
Mattel down 11%. I know Matt was saying this. Slumped as much as 19%. Missing expectations on the outlook for the full year. This coming despite strong 3Q beat on the success of the Barbie film. But Matt, you were quick to point out that success should maybe be thrown in quotation marks.
Yeah, because to me, it's like an incredibly expensive commercial for Barbie. I mean, I saw it. It was pretty good. My takeaway was I like Ken, you know? I'm a supporter of Ken.
Yeah.
But they've only boosted sales with that $100 billion commercial by like 9%. Wouldn't you want to double your sales with an outlay like that? And I looked at the Mattel story. Hot Wheels had a better quarter than Barbie, and there was no Hot Wheels movie, right?
There should be a Hot Wheels movie now.
I agree. They probably are making one. They're so into pushing those things. I actually bought some last weekend.
And what's after the close? We got another big tech name, right?
Yeah,
Amazon.
A company called Amazon.
There you go. Okay.
which is down 1.5%, was kind of treading water a bit. I mean, in a day that we have Microsoft down 1.8%, Apple down close to 1%, Google continuing to trend lower, MasterCard had underwhelming results, ticker MA down 4.5%. So a lot of red and continued weakness as earnings, fail to live up to expectations.
Yeah, I'm looking at Meta. You mentioned, down 6% today, but it's up 135%. Year to date.
Only trailing NVIDIA in terms of the.
And it's funny because Meta, since its inception as Facebook, has been a top line growth story. Yeah. And then last year it became the cost story, and they milked that for everything they could. And you see it in the stock price. Now it comes back to looking at the top line.
Which I can't believe how much money they spend. The top line is impressive, right? They had $34.2 billion in revenue. So 4 quarters of that is like $140 billion. Plus they had more than 3 billion users. I think we were expecting them to have like 3.05, and they actually ended up with 3.14 billion monthly users in the last quarter. Those are huge numbers. But if you look at how much they spend, the market is rewarding them for only spending like $87 to $89 billion this year. That's their expenses. Next year, Meta is expecting to spend as much as $99 billion. That's what Biden has asked Congress to give Israel and Ukraine to defend against terrorism and Russia. That's like a gigantic number.
But that's all going towards AI and VR. So you play in the keywords and that vision of the metaverse that
reality.
I hope it goes to a lot more than that.
It's called Reality Labs. Mandeep Singh, I'm going to take his analysis over yours, Matt. Sorry. Mandeep Singh, who covers technology for Bloomberg Intelligence, basically sat in that seat just a few minutes ago and said, you just saw peak margins for Meta, and that's what the market's saying right now with the stock price. So that's the way to think about it. Spending a lot of money, you're right. Belly Lipschultz, thanks so much for joining us here. We want to get to these markets here. The story's been, it feels to this simple investor over here that the interest rates out there in the marketplace have really been impacting stocks, and that's just my take. Vince Signorella, he joins us. He's a pro, global macro strategist for Bloomberg News. New knee or just a repaired knee?
Replacement.
Replaced knee.
Partial replacement.
Partial replacement knee. He's walking just fine. He found his way into the Bloomberg Interactive Broker Studio. We left some crumbs out for him. Vince, what do you make of these markets here?
The equity market's looking really sick. If you look at longer-term charts...
sick as in bad, like
not
what the kids say,
sick. Not cool sick.
It's looking ill. Yes. Not like Beastie Boys ill, but like unwell.
Unwell.
Yes.
There's a level to watch at around 4150. It's a TD sequential level. If that breaks, it actually opens up a major move down to 4,000. We're looking at a potential major move lower in equity markets if these levels don't hold. And we're going to need to see some help from probably Amazon and the like going forward to lift this higher, because it's not going to come from interest rates.
Well, Abigail Doolittle yesterday showed me... Oh, are you looking at that? No, not RSI. I don't buy that.
That is awesome. Look at the RSI for SPX. We are right there. You buy them right here, unless, as you say, it breaks through that little green line. See, I like the colors and everything.
Give me a break.
If it goes
I'll tell you what, though, it did move below the 200. The S&P moved below the 200-day moving average, and the last time we've seen it that low, in those terms was March when SVB...
And it's well below the 200-day, which is around 42.35, so we're well below that. So 41.70, interestingly enough, is the average closing price for the last year. So between this 41.50, 41.70 level, I'd love to see it hold and maybe catch a bid. But so far, it's looking a little bit of a dead cat bounce here.
If I see rates up, as Paul said, rates have been a huge driver, I feel like. If I see rates up, if I see dollar strength, if I see oil up, that's all bad for equities, right?
Yeah. And you know what? Rates aren't really, there's not much of an impetus for rates to go substantially lower. We need to see really super low inflation numbers to turn rates. At the moment, we're seeing a little bit of a reprieve in the Treasury market. Ackman's trade helped it a little bit. It got some...
Americans want to buy Treasuries, but who else?
Pretty much. There
Chinese, Japanese, foreign buyers, they don't want to hold this paper.
No. No.
Yeah, why not?
Well,
what else are you going to buy?
Well, yeah, that's actually a good point, though. But the upside for it, you're just buying it for yield. You're not looking at it for a capital.
Well, it's the
gain.
first time in almost a generation you could get yield.
Oh no, I mean a lot of people are loving it. You're looking at CDs at 5.5%. I mean these are great rates, especially for fixed income or seniors on a fixed income. A lot of folks out there doing that. I mean, I've done a little bit myself. I'm kind of a senior actually these days. But I mean, I could see rates staying here. I mean, not really going down a lot, not really going up a lot. But that's not going to help the equity market. It's going to need it from somewhere else.
So when a guy like Bill Ackman says, I closed my short in the treasury markets, does that mean anything to pros out there, or is that just a name? No. It's just
and if you think about it, the size of his fund, it was like a 1% gain. So
he was out long too, right? Wasn't he talking about the 30-year?
Yeah.
Yeah.
Yeah, but he had a 1% gain on the assets under management. I mean,
he wasn't the only Bill. Bill Gross also.
What is he, long or short?
He's going long treasuries now.
Well, so is Warren Buffett. Warren
closing
Buffett
is short at least.
Yeah. Okay.
Yeah, they put a position on Monday and tell you on Wednesday what they did. So you'll join in and
By
get
the way,
them into the money.
do those names? The other day, our producer Eric Molo, he had a mask on, and I said, "Hey, dude, where's Tonto?" And he had no idea what I was talking about. And I said, "You know what? Like the Lone Ranger," and he was like, "No, sorry, don't get it." He did not know who the Lone Ranger was. And do these kids today? Do they know Bill Gross? Do they know Warren Buffett, like in a real way? Or?
I mean, the algo programmers do, because they take those names and they program it into their trading venues. But actually, the only iconic name from that era that is actually incredibly well known, Lassie. Everyone knows who Lassie is.
This is not in the markets.
No.
Yeah.
Well, in the world in general,
world.
yeah, markets. I mean, in all the years I traded.
Do you think Eric Molo knows who Lassie was?
I think so. We'll have to test them on the way out.
Check them out. All right. What's the most interesting trade for you out there, just in the markets? I know you look at currency, stocks, bonds, all kinds of stuff out there. What are you looking at?
To me, going back to interest rates, I still like the short term. I still like two-year treasuries. I mean, that's the one that's really going to catch a bid when the Fed decides to turn, or the Fed says, I stopped, because you would more likely than not see the yield curve steepen if inflation expectations remain. That's not going to affect the short end as much. So if you see steepening, it's going to be a sell-off in the back end. I think the short end is the place to be, because inevitably that's got to come your way. The Fed.
Matt's been telling me not to crowd into that 2-year because I'm going to have interest rate risk.
Reinvestment risk.
Reinvestment risk. Now the 30-year, 5.07. You were right. Now you can buy 30
Well, I'm not
years
saying,
5%.
first of all, I don't give investment advice.
I loaded up on that.
And if I do, you should run the other direction. But no, I'm not saying you want duration right now. I'm just, I just look at the the reinvestment risk as something that is better dealt with by, you have like very sophisticated investment advisors. I just look at an ETF. I would rather T-bill and chill,
T-bill and chill. I get Yankee tickets, and you do T-bill and chill. All right, so what are we doing here, Vince? I mean, is the next move for this Federal Reserve to just stay, or to still talk tough? We heard Christine Lagarde, ECB today, still talking tough.
I take that with a grain of salt. They're saying what they have to say. I mean, Lagarde's been, if you go back 10 years when inflation in the Eurozone was below 1%, all you heard from the ECB central bankers was HICP inflation is moving towards target. It didn't move for 5 years, but they said that at every meeting. So now at every meeting, they're going to say we can still raise, but they have no real intention of raising. Neither does the Fed, I think. I mean, the Fed will talk a tough book, potentially raising one more. I have absolutely no idea why. There's really no reason to raise at this point.
Inflation isn't moving down quickly enough.
Yeah, well, what's
they
quickly
need to counter
enough?
Fiscal spending. I mean, it needs to be 2, like last week.
But I would argue this: the idea of getting inflation to 2% goal is ridiculous. The 2% goal was at a time when there was a balance sheet of $1 trillion. Now we have a federal deficit of $33 trillion. The balance sheet at the Fed is off the charts. I mean, you're not going to see 2% inflation. You're going to see 2% inflation if you have a disaster.
Well, you don't think they're going to get there?
No. I think that if they're lucky, they get to 3.5, and they should be happy if they do so.
I'm in that camp. I don't know what's so special about 2%.
They made it up.
Yeah, that's what I feel.
It's literally they
well,
just made it up.
They would all be made up, but the point is inflation is just thievery, right? You're just robbing from savers. So it's their duty to get it down to near as damn it to zero, I would say.
Well, I mean, you're robbing savers if you don't have real interest rates higher, but we now have real interest rates starting to come to the positive. If you get inflation down to 3.5%, you're not going to see a 10-year yield at 3%, so you're still going to have a positive carry, and people are going to be earning. I mean, the other side of the coin is you get inflation at 3.5%. Where does that put the S&P? Probably around 4,800. So you're going to have a positive return somewhere. It's just a matter of where you go.
All right, what do we do? I mean, all right, I think my Fed's going to stay put next time.
I think so too, and I think I look at tech, and I'm always the one where I joke with people and say, you're not going to get your next iPhone from Campbell's Soup. So, whatever they're selling, whenever they sell tech this aggressively, to me, it looks like an opportunity to layer in.
So you want to buy the big tech?
I would buy the big tech, but, just get my feet wet here and there, my toes wet
I
here
don't
and
think
there.
I'm buying the iPhone 15. My daughter, I just looked at it yesterday. It's got a new plug. So you got to replace all your plugs.
Yeah, but it's
and chargers.
USB-C, so it's like much more universal.
I got my plugs strategically located everywhere. None is more than an arm length away.
Dude, I feel
now
you.
I got to replace everything.
I feel you.
That in and of itself is going to hurt the replacement cycle.
Because they made Apple abide by their
yeah, that was
their
a
standards.
regulation move. But I'm happy they finally got to it. But you're right, we have to buy all new cables, and it's a risk.
All right, Vince Signorello, thank you so much. We appreciate it. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. Meta Platforms squashed investors' hopes for a long-term advertising recovery, pointing to an uncertain economic environment. Now, this despite an upbeat earnings report and the company saying that it plans to spend heavily on newer businesses. Bloomberg's Matt Bloxham explains.
Advertising revenue was very strong. They grew revenues 23.5%, which is almost a doubling sequential growth. But yeah, the comments about kind of potential pressure into next year, obviously, with business reliant on advertising revenue, if corporates start to kind of rein in their budgets, and that's going to have a noticeable impact. And they're continuing to spend big sums of money, billions of dollars a quarter, on their metaverse project without any obvious revenue coming through from that.
Now, Meta right now down about 6%. Some better news for IBM. More from Bloomberg's Steve Potisk.
It looks like investing in artificial intelligence was a smart move by IBM. The company has booked a few $100 million worth of generative AI business. Add to that growth in its software consulting and hybrid cloud businesses, and IBM topped forecasts for both revenue and profit in the latest quarter, and it's standing by its full-year outlook.
Shares right now, they're up more than 3.5%. And despite that news, big tech still struggling. Bloomberg reports the so-called Magnificent Seven technology companies that have powered this year's U.S. stock rally are wiping $200 billion off their market value and threatening to push the S&P 500 into a correction. Now, Alphabet, Tesla, Meta Platforms have all slumped since reporting, with Microsoft a bright spot there. Amazon opens its books after the close today. We have Apple and NVIDIA report next month. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We check the markets all day long here on Bloomberg. A slide in big tech is weighing on stocks. The S&P is down 0.6% or 27 points. The Dow is down 0.1% or 37 points, but the NASDAQ is leading the way with the declines. A session low down 1.2% or 149 points. Treasury yields are falling, with economic data reinforcing the case that the central bank, the Federal Reserve, may be done with interest rate hikes. Right now, the 10-year yield is at 4.91%. The 2-year is at 5.06. NYMEX crude's down 2.1% at $83.61 per barrel. COMEX gold is down 0.6% at $19.83 even per ounce. The euro 1.0536 against the dollar, and the yen is at 150.44. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan, thanks very much. Nathan Hager there with your Bloomberg Business Flash. I want to get to the end of the strike. I mean, I want to get to it. I'm sure the union members want to get to it. I know the car makers want to get to it. Let's talk on the telephone, on Zoom, actually, with Keith Naughton. He covers...
Really, on Zoom? Look at him going on.
Ford and the Big Three for us out of Motor City. And it looks like at least Ford has got a tentative agreement with the UAW. Keith, walk us through it.
Yeah, so it's an agreement that includes a 25% raise and the restoration of cost of living allowances. Those two combined mean that the actual pay increase for the top wage earners is actually 33% and means they'll be making over $40 an hour. There's improvements, especially for new workers. They're getting even larger raises. Temp workers are being converted to full-time. They're doing increasing the multiplier on pensions and 401ks. So there's a whole bunch of good economic enhancements that are in the agreement.
Now you use the word pensions, Keith. I imagine you're talking about people who already had pensions who, have been working there since pre-2007? Because I know that Sean Fain, he wanted a pay increase. He also wanted pensions for all the union workers, defined benefit pensions, and he wanted a 4-day work week or a 32-hour work week. So did he get 2 out of 3?
Yeah,
or just 1
if you want to talk about the stuff he didn't get, Matt, he did not get the 32-hour work week or the 4-day work week. He did not get a return to traditional pensions. What he got instead is a larger contribution from the company to your 401k or to your pension. All those before, as you said, 2007, do have traditional pensions. So it's the workers hired in the last 15 years that don't. So they instead are going to have a greater contribution, greater multiplier.
All right, Keith. So, I'm guessing this puts the pressure really on GM and Stellantis. How does this play out from here?
Yeah, I mean, so the analysts are already crunching the numbers, and the Emmanuel Rosner over at Deutsche Bank is saying that this would cost Ford $6.2 billion over the life of the contract, but it actually would cost GM and Stellantis more. GM would be over $7 billion, Stellantis higher in the $6 billions, because they have more temporary workers. So there's more temps to give raises to. There's more temps to convert to full time. So by going first, Ford was able to tailor the agreement to their specific situation. They only have 2 to 3% of the workforce that is temps, whereas GM and Stellantis GM's closer to 10, and Stellantis is over 10.
Interesting.
So does this mean? Ford workers are going to go back to the Kentucky plant. They're going to start building the Bronco again in Dearborn. They're going to put the pressure, in that sense, further pressure on GM and Stellantis. Do you expect agreements from the other two by the end of the day?
I don't, actually. I think there's still work to be done. And that's an important point that you just made, Matt, because back in 2019, when the UAW struck GM, when they reached a tentative agreement, the workers did not go back to the plants they didn't open the plants again until after that agreement had been ratified by the full membership, which took weeks. But in this case, the UAW is sending the workers at Ford back to the plants immediately. The plants are cranking up today because they want to put pressure on GM and Stellantis. The losses for each of those companies just from this strike are approaching $1 billion. So, and just this week, the two of them, GM and Stellantis, had their most profitable plants go out on strike. So the costs are going to escalate more rapidly now.
All right.
So
catch us up, Keith. Catch us up on who's. So the Bronco is made at the truck assembly plant, right? In Wayne, Michigan, actually.
Yeah. So what's coming back online? Is that what you're asking me at?
What's still off? Because I know on Tuesday they struck the GM plant that makes like the Escalade and the Tahoe, right? At least one of them.
Right. Yep. Yeah. At GM, the big plant struck this week is the Arlington, Texas plant that makes all the big SUVs: Suburban, Tahoe, Yukon, and Escalade. And at Stellantis this week, it was the Ram pickup truck plant in Sterling Heights, Michigan, and that is their most profitable plant. For Ford, the ones coming back are the Bronco and the Ranger plant. That was the one that went down immediately. The one that was more recently taken down on October 11th is Kentucky Truck, that makes the biggest F-Series trucks and the biggest SUVs, the Lincoln Navigator and the Ford Expedition.
Hey,
yeah,
Keith,
the Super Duties.
25% seems like a lot to me, even though it's over a number of years. What are the auto companies getting here?
Well, they're getting labor peace, which, costs something. But they're getting richer contracts, and they already had the highest labor costs, in the industry. So what GM said, Mary Barra, the CEO of GM, said during their earnings call this week, is they're going to try and find offset. They're going to try and do cost cuts to, make up for this. But it's these are expensive deals, and they're going to have to find a way to get their costs competitive.
That makes me worry about the vehicles. Ouch! You're going to start. So what? Putting in like lower quality parts? That's what I worry about. That's what everyone who's buying these cars and trucks, Keith. I spend a lot of time on the forums, right, of many different brands, and they're all like, "Oh, stay away from that company because they're going to strike." And even if they didn't strike, maybe they will, and workers are going to be unhappy and not do as good a job. Yeah, but if they cut costs, does that mean we're going to have lower quality components?
Not necessarily. I mean, in companies as large as these, there's all kinds of waste and redundancy that you can work on. I mean, they cut by the billions when they're cutting costs. And obviously people is one of the ways they cut costs. Let's not forget, Jim Farley said just a year ago that Ford had 25% more engineers than its competitors. He's been cutting salaried staff by the thousands. So, there's still probably people that he will cut as they continue to move into their EV future from their internal combustion engine present.
So I know, Keith, for the unions, one of the asks or demands was something nebulous to me, at least, which is, hey, can you guarantee we're going to still have the same number of positions in an EV world that we have in an ICE world? Did they get any language to that effect?
There is some job security in this, and Ford had told them that they would not lay off anyone during the term of this contract, which is 4 years and 8 months.
Okay.
And in fact, would add to workers. But it's not an idle concern by the union. It takes 40% less labor to assemble the powertrain of an electric vehicle than it does an internal combustion engine vehicle, which has thousands of parts versus about 20 in an electric vehicle. So, that is coming, and they got to figure out how that's all going to work out.
What do you think this deal looks like to non-union shops, Keith? I think of, the BMW plant in Spartanburg or the Tesla plants.
Is that where my X3 was made?
Your X3 was made in Spartanburg. Yes,
okay.
In fact, it was.
Very good.
Very cool plant and cool truck. I like it a lot. But what do you think about those shops? Are they going to look at this deal and say, we should have a union too. We should be in the UAW.
That is what the UAW is counting on. So it depends on, when you say what does it mean for those plants, it depends on who you're talking about. If you're talking about the companies themselves, the CEOs, I think what it means to them is the price of poker just went up. And the way they've kept unions out of their plants is they've offered equivalent wages and benefits. So if the CEOs want to keep the unions out of their plants, they're going to have to give everybody a raise at those non-union plants. If they don't, the UAW has a big opening to go in and organize them.
All right, very good. Keith Naughton, thanks so much. We appreciate that. Keith Naughton, he is a reporter for Bloomberg News in Detroit. He is our go-to voice there. And again, we get a deal from Ford, and presumably, Matt, that means Stellantis and GM, a little pressure on them to get something done because Ford is back out cranking out the trucks here. The big piece of news today on global Wall Street is Morgan Stanley. We have a change in leadership there. Mr. Gorman's stepping down, and they're electing a new CEO. I'm going to check in with Allison Williams. She covers all the big investment banks.
So hang on a second. Is Gorman going to actually step down and leave? Or
no, he's going to be chairman.
Executive chairman, I see.
And now John Mack, when he stepped down as CEO, he stayed for 2 years, I believe. So I'm not sure what the timing will be for Mr. Gorman, but it's, a big time.
He's 65.
Yeah. He's had a heck of a
young,
run.
Right? I mean, I feel like the retirement age, we were talking about this in the newsroom the other day. Don't you think it's a little higher now?
Oh, totally.
I think like 70 is more realistic.
Yeah, and there's a lot of people like yours truly that's never going to stop working.
True.
I mean,
well, me either. You know? I'm going to be chasing
exactly.
that long white line.
Yeah.
But so Ted Pick's only 54.
Yep.
He's got some years in him.
Yeah, sure, absolutely, and he's a big person or big executive on their trading side. Fixed up the equity trading business, and then went over to
the great financial crisis.
Yep, and then went over to do the same thing in fixed income. And it's a real interesting issue here because the biggest part of Morgan Stanley these days, after Mr. Gorman's management tenure, has been their wealth management business. That's really what's become the big driver of the firm.
Well, that's all down to Gorman, right?
Yeah, exactly. And the folks on Wall Street like that. Allison Williams joins us. She covers all the big investment banks for Bloomberg Intelligence. She used to be a fund manager and analyst at Morgan Stanley Investment Management. So what can you tell us about the new CEO or the CEO to be, Ted Pick, Allison?
Well, the most important thing is that we have some clarity. I think it was rather unusual, not unusual that Gorman is stepping down at this time, but it was unusual that he announced he was stepping down and then sort of outlined that there were 3 clear front runners. And so certainly among the investment community, I think clarity in terms of who that person is important. And I think for the firm, it's important they get that direction. So Ted Pick, I think, has been for a while the front runner. If we go back to a couple of years ago when he and Andy Saperstein were, sort of made co's of the bank. And I think that Andy runs the bigger wealth management business that has certainly grown, especially through acquisition under Gorman's reign. However, as we know, the institutional business is very complex, and Ted has that expertise, and that's where he's come from. He has a strong track record in his earlier days as a manager, first leading equities to that #1 position, and then, really improving FICC. However, those businesses have had a step back recently, and we think that that's really going to be a focus of his going forward.
All right, Allison. We're going to go right in just a matter of moments to Sonali Basak, Bloomberg Television. Sonali Basak, she's actually at the Morgan Stanley headquarters. I'm going to sit down.
Once again, proving that she is our star Wall Street
She is our
reporter.
star Wall Street reporter. That's how we introduce her, and she's going to be sitting down with James Gorman and the CEO to be Ted Pick, and just kind of get a sense of, the succession planning, which is so important for big companies, including the big investment banks, and see what the future holds for Morgan Stanley. What are some of the strategies, as Allison was just mentioning? They've had a couple of setbacks in some of their trading operations recently. The deal flow seems rather, shallow on the street these days. So there certainly are some challenges for global investment banks, including Morgan Stanley. But again, this looks like a nice succession planning being executed. So right now, let's go to Sonali Basak. She sits down with Ted Pick and CEO James Gorman of Morgan Stanley.
Welcome now, our Bloomberg TV and radio audiences. Morgan Stanley's succession race is over. Sonali Basak joins us now with Morgan Stanley CEO James Gorman and incoming CEO Ted Pick. Sonali, over to you.
Indeed. Welcome to our Bloomberg television and radio audiences. I'm standing by now with Morgan Stanley CEO and Chairman James Gorman and incoming CEO Ted Pick. Big moment for Morgan Stanley, 14 years at the helm. How does it feel to be passing on the baton?
Feels great. For several reasons. One, it's time. Organizations grow because you have change. I mean, you're not going to grow by doing the same thing again and again. And I feel like we set this up several years ago with the board. We've had a very, very intentional process, and we ended up with a phenomenal outcome, which is Ted. And we've got other unbelievably good executives who are taking leadership roles as co-presidents, Andy Saperstein and Dan Simkwitz. So it's sort of what you hope for. I mean, you try and drive strategy, you try and put together a team, you try and deal with the inevitable knocks that you get from the market and the disappointments that come in times in any complex business. But at the end of the day, you're also trying to hand it off for the next generation. So it feels great, and it feels right.
You've been rumored to be a CEO contender for oh so long, Ted. How does it finally feel to step into the role next year?
Sonali, Morgan Stanley was the first place that I worked out of college. And 33 years later, I'm sitting next to Mr. James Gorman. It's the thrill of a lifetime. I'm so excited.
Now, you've really inherited a gift here, a massive transformation over 14 years, one of the best valuations here in global banking. But there are investors who are worried this is as good as it gets. What do you tell them?
There's more to come. There's more to come. We look at the 5-year chart, the 10-year chart, the 15-year chart. The wealth and asset management businesses have these remarkable durable earnings. The Global Investment Bank has lots of miles to go. So we're thrilled about the business strategy we have in place, and it's going to continue to deliver long-term value for shareholders.
Now, for both of you, we've been in such a prolonged bull market that has hit such volatile times as of late. Do you expect the next couple of years for Morgan Stanley to be a little more choppy?
I don't know. It's I thought this year would be tough, and it was. A lot of what's going in the market conspires against our particular business mix. Some of the more commercial retail banks, mortgage banks, very different business model. But our turn will come. I think, I personally think the U.S. has dodged a recession. I think the Fed is very close to being final, within probably 25 basis points. We're starting to see activity. Look at the Chevron deal we just announced the other day. I mean, phenomenal. So we're seeing activity in different sectors. It's coming alive now. So no, I think the next couple of years will be great. But what I care about is over the really long run. When we set about on this journey, we weren't focused on a quarter. And if the stock takes a dip in a quarter, I say that's kind of good news because we're buying back stock. And every share you buy back, you're retiring a dividend. So shareholders who hang tough are getting a 4.5% yield, and we're buying back stock, and the stock's cheap. So it's kind of a good situation to be in. But medium term, no, I think the firm is going to do great.
Ted, what are the biggest challenges for you as you navigate this environment?
There's just so much opportunity. We're definitely in a new paradigm. Interest rates are going to be higher for longer, and the world's gotten smaller, which means the clients need advice. They need it in the wealth and asset management space. They need it in the institutional space, our corporate clients, and we're going to have lots of activity around those clients. So I just want to make sure that we are completely aligned in the business strategy we have in place. It's something that James has painstakingly put together for 14 years. The market knows what we want to do. So I'm incredibly optimistic over the next couple of years.
Now, a lot of lessons have been learned in this building over the last several decades, really. What to do, what not to do. What is the Morgan Stanley playbook of what not to do in 2024 as you navigate this new environment?
Well, I think it's to continue to do what we've been doing, which is to treat each other with respect. This process that James and the board ran was intentional. It was respectful. I couldn't be more thrilled to be working with Andy Saperstein and Dan Simkwitz, two of my closest friends. They are extraordinary leaders. They're going to drive these businesses. The fact that we've worked so collegially, this is the kind of Morgan Stanley that we've known and loved, the blue Morgan Stanley of respect and focusing on clients. And during this painstaking process, there's been no loss of focus. We've been focused on our shareholders, on our clients, and the fact that today we had a celebration with our partners, and it was really quite a wonderful experience, shows that we are on the ball and sticking with the future.
I'm glad you mentioned Andy and Dan because a lot of questions here around, they were two CEO candidates. Now they're going to be the co-presidents. How do you keep them around? Are you holding them to any lockup periods?
No, they've got phenomenal job opportunities. Andy's co-president. He's now running not just wealth management, which included E-Trade, but asset management, which includes Eaton Vance. So he's overseen the biggest wealth and asset manager in the world at what I believe is the most prestigious and best investment bank in the world. Dan came out of capital markets and is now going back there after a great stint running asset management, and he's going to be running all of global trading, banking, capital markets, his old home turf, research, and most importantly, the two of them are going to work with Ted in helping to manage the firm. So, no, these are phenomenal opportunities. They're high-quality people. These are some of the best jobs on the planet, and, we're delighted to have them.
Now, I'm glad you brought up the institutional securities business. That is your old home as you move to the new spot. But, what's interesting, you've long been the #1 in equities trading. Lately, Goldman has surpassed Morgan Stanley in a couple of quarters, while JP Morgan and Goldman have been faring better in various forms of M&A and underwriting. Do you have a plan to be #1 again?
Listen, we have some great competitors, as you know, in the global investment bank, in equities and fixed income, and then across investment banking. We're focused on being #1. We want to have the right people in place. We've been investing for the next cycle. That next cycle is going to be investment banking led. And it means that in equities, we want to be 1 or 2 every quarter as we have been for the last decade. We have a fixed income business. We restructured. It's now a top 5 business. And investment banking is going to lead the next cycle. There's going to be a lot of M&A consolidation. It's going to be across industry groups. The world's gotten smaller. There's a new cost of capital. We want to be a leader, a global leader in all those spaces.
Now, James has hinted before to the possibility of more mergers and acquisitions for Morgan Stanley moving forward. You've already done some very transformative ones. Do you feel, Ted, that it's a matter of time in the CEO seat before you can do a significant deal? Or do you feel like you can jump right in?
Well, I think we now have done 3 major acquisitions over the last 15 years, all of which were in James's vision. Smith Barney shortly after the financial crisis, E-Trade at the dawn of the pandemic, and then Eaton Vance. Those are 3 major integrations. We like what we have. The business strategy's in place. Let's execute on what we have, keep the strategy in place. We always talk about acquisition candidates, but that's off into the future.
Now, the other thing, James has said that there were a few things you'd rather get out of the way before stepping down, including the U.S. investigation into Morgan Stanley's role into the block trading market. Is this something that can be resolved before you step down?
Well, I'm going to stay, as you know, Sonali, as executive chairman for a period of time. We'll see how long. Frankly, I shouldn't stay too long because it's Ted's job to run the firm now. So I'm going to be there just to help him in whatever way and obviously meet with regulators around the globe who I've got to know over the last decade plus and key clients. And also in that period, there are a few things I want to still clean up. I want to hand, I said, as clean a plate as possible. These are monster jobs and enormously complex. You travel a lot. There's a lot that comes at you. So I think it's nice to start with a clean plate. We wouldn't have announced I was stepping down if we didn't think whatever we still have left isn't manageable. I mean, I wanted to see CCAR through. We came out of that actually with a better capital ratio than we went into it. 12.9 CET1 requirement. We're at 15.5. I wanted to see the initial Basel proposal. We've seen that. I don't think it will end up where it is, and we're working very closely with regulators. I want to see the sort of summer months. Obviously, a difficult quarter. We knew that was coming. So I wanted to just see the firm through that and then through this transition of leadership. So, no, we're very comfortable with where we are in the process, and I'll do everything I can to help Ted and help Dan and Andy.
Now, one large issue that has been plaguing Wall Street is the lack of gender and ethnic diversity at the top ranks. And when this CEO search had come to its final steps, there were no women or people of color that were considered for the CEO ranks. What is your plan to increase representation in the top ranks at Morgan Stanley?
The next generation has lots of representation of all types. It's a priority. It'll continue to be a priority.
Do you have specific goals over the next few years to make sure that's, the
well,
next set of
Shania, it's a good question. We run a meritocracy, and diversity comes in all types. And we have fantastic women and men from all backgrounds in senior positions on operating committees throughout the firm, and I couldn't be more excited about the look of the firm in the next 5-10 years.
Now, I know you've said also that, largely the strategy is in place and it will be continued on into the new leadership. There is one thing that is very much in the mind of CEOs lately, and that's technological disruption happening at a rapid clip. How are you thinking about how this could change Morgan Stanley and its positioning in the future?
Well, Walter Wriston said it best. He said the most, I don't think he was totally right on this, but he observed the most important technological evolution for the financial services industry was the ATM machine. And each generation, if you look at it, has embraced technology into the businesses to make them better. What Ted did with the electronic trading and equities, so-called MSET, phenomenal. And that basically fed all of our trading apparatus that has supported that business being, again, number 1 or 2, depending on the quarter, but right up there. What we've done with E-Trade. E-Trade's a technology company with a brand. What we did with ShareWorks and what is now Morgan Stanley Work, the electronic stock plan business. And Solim, we bought. Solim's a company of programmers in Calgary, Canada, and that became the birth of the stock plan business. So there's always technological revolution. What Andy Saperstein is now doing in the AI space, sort of building off the early machine learning we did to create virtual financial advisors. It's endless. We just had a presentation of the board on it. So it's in everything we do. We have nearly 20,000 employees, direct or consultants, working for us in technology now.
Before I let you guys go, what is the one biggest piece of advice that you have to Ted as you pass over the reins?
Enjoy it. It's an incredible privilege to be able to make the call, to make decisions. Sometimes you'll be wrong. The only way to be right is not to make any. So I took the approach of, I was looking for, I don't know what the analogy is, something at bats, so I'm not really a baseball player, but I wanted to make enough decisions where we got a lot of things right. And along the way, a few things mightn't go your way, but that's okay. Just enjoy the journey, embrace the good bits and the bad bits, as Kipling said in If, and those imposters of success and failure. And, keep yourself focused on the long term. You're going to have great quarters and you're going to have disappointing quarters. You're going to think the stock should be up when it's down and down when it's up. None of that matters. What matters is the long-term health of the franchise, the values, and your own stability in that role. And part of that is building a team. He's off to a phenomenal start in 24 hours. He got a standing ovation from the board last night. We had a wonderful dinner with directors. We had all partners live in this building today and broadcast around to our 83,000 employees. So, enjoy the moment. It's an incredible privilege.
Ted, James, it was a pleasure to spend time with you on such a landmark day for Morgan Stanley, and hope to see you at the turn of the year when you take your new job.
Thank you so much.
Thanks, Shonali.
All right, that was Shonali Basak, Bloomberg Television Shonali Basak, sitting down with Morgan Stanley CEO James Gorman and CEO-to-be Ted Pick as they make that transition, the succession of leadership at Morgan Stanley, a seemingly seamless one as well. So kudos to them, and great for Shonali to get a couple of minutes with each of those individuals. Right now, let's get a reset here. We'll go down to Nathan Hager in Washington, D.C. and get an update here. Nathan.
Not apropos of anything here, Paul, but Morgan Stanley shares are higher by 1.2%. Broader market is lower, though. The focus on big tech earnings adding to the slide. The S&P 500 is down 1/3% or 14 points. The Dow is little change to the downside now, down 4 points, but the NASDAQ still moving lower by about 2/3% or 83 points. Investors are punishing companies reporting weaker than expected earnings, including the disappointing outlook on advertising growth from Meta platforms. Those shares are down about 3% right now. Julian Emanuel, chief equity and quant strategist at Evercore ISI, takes a broader view.
The 5% yield and the geopolitical situation that we're confronting right now is compressing valuations. You will have stocks that do well in earnings. You will have stocks that do poorly in earnings. But at the index level, there is a hesitance into the conversation.
The yield situation being driven by really strong economic data. We got a big jump in third quarter GDP, and that's sort of reinforcing the case for a lot of traders that the Fed is going to stay on pause next week. Right now, the 10-year yield is down about 6 basis points, 4.89%. Policy sensitive 2-year down 7 basis points to right around 5.05%. NYMEX crude is down 1.6%, right around $84 a barrel for West Texas Intermediate. COMEX gold is down 0.3% at $19.8950 per ounce. The euro is at 1.0540 against the dollar, so a little weakness on the euro. The yen is at 150.37. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So you can head over to youtube.com and search Bloomberg Radio, and that'll get you where you need to go. So looking at that GDP print this morning, there's a lot of economic data this morning, Matt, but that GDP print, 4.9%, kind of the headline, kind of grabs a lot of the attention there, and it just kind of suggests that at least on a look-back basis, pretty darn solid.
Yeah, absolutely. And the question now really is, what about this quarter?
Yep.
You know, this current quarter? Because, for example, we were talking with the Bloomberg economics chief U.S. economist Anna Wong yesterday, and she said she thinks we're going to look at stagnation in Q4. After such a huge Q3, we're going to get zero, or maybe a little more, maybe a little bit less in Q4. And she is still expecting a recession next year, and you're hearing that really the kind of dour attitude about the outlook for 2024 from a lot of people, even though we have now 5% growth, you know, less than 4% unemployment, a 50-year low in that case. So it seems like it would be a huge turn, but
again, quite frankly, the street and economists have been calling for a recession for 18 months now. So we have to take that with a grain of salt. Michael McKee joins us. He is our international economics and policy guru. He's down in Washington, D.C. So, Michael, Matt and I were just talking about these economic data that we got today. And again, really strong GDP number. How do you put all of this into context?
It's kind of hard to put it into context because we can't really figure out why everybody was spending so much money. Consumer spending extraordinarily strong, going up to 4% from 0.8%. Is that sustainable? That is the real question. A lot of people on Wall Street don't think so. And then the other side of that question is business spending, which was up 7.4% in the second quarter, was down 0.1%. So what happened there? Did businesses start to think we were going to have a recession? The numbers kind of don't tell a story of what is going to happen next. And so that's going to make it hard to figure out what the fourth quarter is. And so far, what I'm seeing is basically economies sticking to what they predicted before the number came out. If they were thinking we were going to have a contraction, they're still thinking it. If they were thinking we could go on and have a strong fourth quarter, they're still thinking that.
So Anna Wong yesterday told us she thinks this surprise growth, or I don't know if it's a surprise to economists, but to me, 5% seems like a lot at a time when we're all preparing for a recession. It has to do with the strength of the U.S. consumer, has to do with the strength of exports, and I guess a drawdown in inventory. Is that the kind of stuff that's not sustainable for Q4 and Q1? I mean, is the consumer tapped out?
Well, we don't know. That's the problem. We will get more information tomorrow when we get the income and spending report. We'll see what incomes look like. There's no good way to measure the pandemic bonus that people got and how much of that is still left. Even though people try, the consensus is you can't really do that. So we're not sure whether the consumer will continue. Today we got strong durable goods orders numbers. Does that suggest business is going to bounce back? Those were September numbers, so they were third quarter, but does that set us a new starting point for the fourth quarter? A lot of questions there. Now, inventories did bounce back some. They went from virtually nothing to $80 billion. That's not a lot, but if inventories are building up, particularly ahead of the holidays, then that'll add to GDP in the fourth quarter. So I'm trying to make a forecast out of the third quarter GDP figures, and it's really hard to do.
So, Michael, I know you're down in Washington, D.C., so I just assume you were the one that got this speakership over the line, so thank you very much for getting that done. They got some work to do here. I mean, you're down in Washington. What's the feeling about, getting November 17th and dealing with the government shutdown and maybe getting some funding. What's the feeling down in D.C. these days?
There's a sort of a general consensus that because things were so messed up that the House will probably agree to a continuing resolution before November 17th. The only question is for how long, and the kind of bet, maybe just a little bit over a 50% bet, is that they will punt it into next year. And the reason being is, if there's no, according to the agreement they made when they extended the debt ceiling, if there's no budget bills passed, if they haven't come up with the actual spending bills by the end of this year, then every program gets a 1% spending cut. But that doesn't take effect until April 1st. The program gets a 1% spending cut. But that doesn't take effect until April 1st. So the feeling is they've got until April 1st to actually get something done. It would be interesting to see if they actually got something done, because they haven't passed all of the 12 spending bills through both houses in about 30 or 40 years.
So, but if there's no agreed budget by December 31st or January 1st, then we get an automatic 1% cut across the board. Is that sequestration?
Yes, essentially that's what that is. It sort of was set up as an enforcement mechanism to kind of push both houses to get their appropriations bills finished, which of course they didn't do. I don't think anybody really expected them to, but obviously when you cut 1% out of everything, both parties are going to find things that they're unhappy about being cut back. So the feeling is they may actually get these things done. Now the question is, where do the Republicans in the House go? Because in the debt ceiling bill, all sides agreed on levels of spending. The Senate has crafted its bills, which it hasn't passed yet, but has them ready to go at those levels of spending. But the House, up to now, has been cutting back, not living with the deal they made. So do they change that? Or do they still try to pass these bills that would severely cut back specific programs, in which case the Senate is going to say, forget it. They could negotiate, but will the Senate negotiate those numbers? And if numbers came in lower, much lower than the deal, would Biden sign it? So there are still questions about whether we end up with a government shutdown. It's more a question of when does that pressure start to build?
Wow.
I wonder, or sequestration, which would be interesting, because, I mean, Lord knows we spend enough money. Is the spending, what Paul and I can never really see is, after we get a CHIPS Act or an IRA, after we get, this trillions of dollars in spending approved, when does it actually go out and hit the economy? Is that happened already? Is that why we have 5% Q3 GDP?
You'd think so, except that the way the numbers broke down with no business spending this time, no investment. Government investment was up a little over 2%, which is about what it has been, and a certain amount of that is obviously defense spending. So it doesn't really show up. Now, that money is hitting the economy, and we should see it help buoy growth going forward, but it wasn't an outstanding aspect of this.
All right, Mike, thanks so much for joining us. Really appreciate it. Michael McKee, he covers all the economic stuff for Bloomberg Radio, TV. He's kind of all over the place. He's down in Washington, D.C. right now, trying to get those folks in shape. All right, we're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates
for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Jen Flitton. She is head of government affairs at Invesco. Get her thoughts on Mike Johnson being selected House Speaker and a potential government shutdown and where we go from here. And of course, it is earnings season. That means we turn to the experts, the research analysts of Bloomberg Intelligence. We're going to break down the tech numbers, including a preview of Amazon after the close tonight with Anurag Rana and Mandeep Singh. They are senior tech analysts of Bloomberg Intelligence. And then we're going to switch gears to the transportation sector. Lee Klaskow, senior transportation analyst at Bloomberg Intelligence. We're talking about UPS earnings, a little bit disappointing here, and what he's seeing in the transportation space with the rails and trucks and all that good stuff. But right now, let's kick it all off with Nathan Hager.
All right, Paul, thanks. A sell-off in big tech is taking hold in markets. Not even a slide in bond yields is bolstering the sector that has driven this year's equity rally. Check the markets all day long here on Bloomberg. Right now, the S&P is down 0.3%, down 11 points. 4175 is the S&P level, below 4,200. The Dow is up 25 points. That's a little changed. The Dow level is 33,063. The NASDAQ leading the declines, down 0.7%, down 90 points. 12,730 is the NASDAQ level. 10-year Treasuries up 13 seconds, yield 4.89%, a drop of 5 basis points. The policy-sensitive 2 years down 6 basis points, 5.05%. That's after we got that 4.9% read on third quarter GDP. U.S. economy rising at its fastest pace in nearly 2 years. What's it going to mean for the Fed? Lindsay Piegza is chief U.S. economist at Stifel.
Right now, the market is very much discounting that third quarter number, focusing instead on the latest central bank decisions, the BOC, the ECB, as a proxy for what to expect from the Fed next week, suggesting that developed central banks around the world, despite still elevated inflation, are starting to pull back in anticipation of a slower level of longer-term growth.
And that GDP surge again, not doing much to move bets that the Fed is going to pause next week. NYMEX crude is down 1.8% to $83.86 per barrel. COMEX gold is down 0.3% at $19.8940 per ounce. The euro is at 1.0541 against the dollar. The yen is at 150.35. We continue to watch Meta Platforms down 3.3% following the disappointing outlook from the social media company on advertising growth next year. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. And we're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Radio, Bloomberg Global News, anything will get you to our show. Looking at the market here, red and green on the screen, as Nathan was just reporting. Let's check in with Jess Minton. She covers all these markets for us, and she joins us live here in our Bloomberg Interactive Broker Studio. Jess, what are you looking at today?
Well, I'm actually looking at when you use the S&P 500 in the terminal, and you can look at the max drawdown. So looking at the July highs, which was on July 31st. How do you do that, Max? So if you go and you make a G chart for just SPX.
Yeah, go ahead. Tell us what it tells us.
It's actually pretty simple. There's an add data tab, and you can just type in max drawdown.
Okay.
And so then you can see it. So you'll see basically on that chart. So right now, the S&P 500 is a little bit more than 9% off of that July 31st peak. So basically, if it hits the 10% threshold, that technically would be a correction from obviously what we would have seen there. So roughly, if you look at that, the S&P 500 would need to be around roughly 4130 for it to reach that 10% threshold. So right now, the S&P 500 is actually trading around 4171. The trading range between May up until recently was around 4180. Actually, at those lows coming out of March, 4180 to 4200. So right now the S&P 500 is broken a bit below that. So that's something that, especially if it gets closer to that 10% threshold, that traders are keeping a close eye on. Obviously, when you do have, particularly if you're looking at the sectors that are driving things lower, communication services down 2%, information technology down more than 1%. Obviously, that does house a number of those big tech and growth stocks. So when you do have big weightings like that, obviously weighing on those sectors. But those are some key thresholds at the moment that a lot of traders are keeping a close eye on, Paul.
I wonder why. Sorry, blue button. I wonder why. So real estate is the biggest gainer on the S&P today. Is that a defensive move?
Well, when you look at the ones that are higher, so utilities also up close to about 1%. Then you see materials at more than 1% too. But that's definitely more of kind of a rate dynamic move that you are particularly seeing in real estate there. So a lot of those names, especially if you're looking at some of the retail REITs as well as the hotel and resort REITs, also industrial REITs are up more than 1.5%. So you are seeing those stocks, particularly among the winners today, and obviously kind of a sea of red there, but definitely more defensive kind of oriented type names there that are selling off. But also if you look over at energy, down 0.8% overall for the S&P 500 sector. So you are seeing that pressured as well.
Toy stocks. Hasbro shares slide after lowering sales view ahead of holiday season. That kind of goes to the big,
We just heard from Mattel after the bell yesterday.
I know. We heard from Mattel. And Barbie didn't quite move the needle as much as Matt would have thought.
I don't understand, Jess. They made a whole gigantic $100 million movie out of it.
And they had this licensing deal with Disney that they lost out on to Hasbro in recent year, right? And one of the big things, especially a year ago, was not just Mattel, but a lot of these different retailers in general that had overstocking and inventory issues. And so that was supposed to be something that was maybe a bit more hopeful for this time around. But looking at more of those outlooks, that was still a concern there. But especially when it came to the Barbie, the licensing deal with Disney, I know that Paul always likes to talk about Mickey Mouse.
I feel like it changes. I feel like the Barbie movie changed the social acceptance. Right. Barbie was essentially getting canceled, right? For years because progressives were worried that her proportions were unachievable. And I mean, I'm talking about my wife mainly. She thought we're never going to get Edna a Barbie doll because, it's impossible. She's impossibly like long-legged and, this blonde ideal that's
right.
And then the movie came, and my wife loved it so much, and she's like, "All right, fine, you can get Edna a Barbie." Now she likes it, and that's not just my anecdotal experience, right? I've heard that everywhere. So
yeah, and also Citi was more optimistic on the catalyst for the growth ahead for Mattel over actually Hasbro just because of that licensing deal with obviously Disney. But I mean, just in general with the toy industry, they have faced a lot of different issues, whether it's you're looking at what's happening with the inventory backdrops, or even, I know a lot of people like to talk about a downbeat consumer, but look at all this economic data that's coming out. We're getting another reading on consumer spending on Friday, tomorrow, and obviously the PCE. But when you're looking at these latest GDP numbers, and especially being propelled by consumers, where exactly, it's kind of hard to argue, right? When Paul and I, when we talk a lot about these different recession calls.
By the way, I'm just seeing now, Carol Masser and Tim Stenovec are going to interview the CEO of Mattel this afternoon on Bloomberg Radio.
Oh, yes, they're on the road.
I'm trying to find out what time. But so my thing is this. You spend so much money on a Barbie commercial, and then Hot Wheels outsells Barbie in the quarter. Does that tell you that, I mean, they did a great commercial. Does that tell you that advertising, Paul, is broken?
You say commercial, you're talking about making them the movie?
The movie was an ad. It was a giant ad for Barbie.
I just want to get clear for our audience.
The interview is going to be at 4:20.
Okay.
That's perfect.
Yes. Explain why that's perfect.
In any case, I just feel like either they somehow missed the mark, which I don't think they did because it was a fantastic film and it changed attitudes about this product. To accepting from repulsed.
But to your point, the Hot Wheels.
But Hot Wheels didn't even have a commercial, and they've outsold it. So only a less than 10% gain in sales? After a big spend like that, wouldn't you expect
I mean, that's what
30,
a lot of
40?
Analysts were expecting and were betting on.
All right. Well, I'm just seeing here, I mean, just in the Bloomberg reporting, I mean, company calling out tougher conditions in the broader toy industry following a pandemic-fueled boom in spending that has since tapered off. So another pandemic-fueled industry. I guess when you're locked at home, you bought your kids lots of toys, and now you got tough comps setting up. All right, very good. Jess Metton, thanks so much for joining us. Always good getting the latest there. Let's turn our heads to Washington, D.C. Why? Because we kind of have to. Jen Flitton, she is head of U.S. Government Affairs at Invesco, joins us. So, Jen, we actually have a Speaker of the House now. I guess that's a good thing. What are you taking away from, I know you're based down in Washington, what are you taking away from the last couple of days of what we've seen in the House?
Yeah, well, it's been particularly difficult for House Republicans. It's been a rather embarrassing 22 days. And so I think a series of frustrations and bloodletting in the family meetings finally resulted in complete exhaustion. And Mike Johnson, who is a fairly well-liked member of Congress, although relatively unknown outside of Washington, there was unanimous support. So I think he came in at the right time. And I think a lot is going to be said for his ability to move forward. Hopefully he'll be able to take that unanimous support and move it into the legislative
So does
sphere.
this mean that Donald Trump is now back to holding the most sway of the Republican Party? Because what we do know Mike Johnson for is leading the way on that amicus brief to overturn the election results. Mike Johnson is an election denier. He doesn't believe that American democracy worked in 2020. He doesn't believe that President Biden fairly won the election. And all of the people in his party supported a person like that for Speaker of the House. Does that mean, well, either none of them believe in the U.S. democracy or they're all sort of heeding the Trumpian call?
Well, first I'll say Donald Trump is the de facto leader of the Republican Party. There is no doubt about that. He is the former president. He's running for re-election, right? And he is the leading candidate in the primary. So, there's little doubt that Donald Trump is the leader of the Republican Party. That being said, he did have some sort of force within the last 22 days, putting in his support first for Jordan, who failed, quite frankly, then opposition to Tom Emmer, who had already had about 26 votes against him already. So whether that sank him or whether that sort of sealed the deal, I think is sort of an open question. But moving forward, into 2024, into an election year, I have no doubt that this Republican conference will be united behind whoever is the Republican primary candidate. And right now, Donald Trump is taking a heavy lead there.
All right, so where does the Republican Party go now? Where does the House go now from a legislative perspective?
Well, two things, right? So first, they have to get appropriations bills across the House floor. And they need their appropriations bills because they are marking to FY22 levels. The Senate is marking to FY23 levels. That is a big disagreement, right? So over the next several weeks, you're going to see the House Republicans moving the House appropriations bills across the table. That will be quite a feat on some of these bills, which are rather controversial, to keep that Republican majority united because they only have a 4-vote margin. They can only lose 4 or 5 votes depending on the day, depending on how many members are in town. And so that will put them in the negotiating position that they'll need to have in order to negotiate with the Senate on government funding going forward. And then, of course, there is the defense supplemental that the White House sent to the Senate last week. It's currently being debated, discussed through hearings, through regular process in the Senate. I expect the same to happen in the House, but that's going to take a little bit of time. And that's funding Israel, Ukraine, Indo-Pacific, the border, and there are going to be a lot of disagreements, a lot of controversies around the policy that surrounds that money.
In terms of cutting spending, is there any hope that these Republicans are going to be able to rein it in after we've seen, basically deficits since Bill Clinton? Say what you will about the philandering of William Jefferson Clinton. At least he balanced the budget, right? Is there any hope that something like that happens ever again in our lifetimes, Jen?
That's right. And Bill Clinton came together with House Republicans, with Newt Gingrich, and was able to do that really in a bipartisan way. I don't necessarily see that sort of work being done between the White House and this Republican conference in the House. I do think, though, we will see it's going to naturally happen because of the debt ceiling deal, the parameters set forth. Either there is a 1% cut across the board starting January 1st, or they are able to come to some sort of agreement on appropriations that is going to lower the levels of spending. Because you're right, we're facing a $33 trillion national debt, over $1 billion a day in interest payments. The numbers came in on our deficit this year. It's about $2 trillion. That's more than $2 trillion more than we're bringing in, right? We're spending. That's a real problem.
And much more than had been anticipated.
Voters. Yes, exactly.
Wow. Into a 5% GDP in Q3.
Exactly.
It's not like we're trying to spend ourselves out of a recession here. I mean, this economy is on fire.
And fuego. Yeah. So, Jen, is there any reason to believe that this new speaker will have any more success than the prior speaker in terms of dealing with the extreme right in the party, whether it's those 6, 7 people, whoever they are?
He's just dealing with himself.
Yeah, that's a $64,000 question, right? I mean, this member has only ever had to speak for himself and for his constituencies in Louisiana. He has held a leadership position in the sense he was vice chair prior to the speakership. So he's been at the leadership table. He's heard the strategy. He's been part of that discussion. So he's coming in with some context, some awareness, and he certainly had to understand the factions and what he needed to do in order to bring together the members of this conference in order to get to the speakership. I think going forward, he has suggested in his run for speakership earlier this week with the conference, he has suggested that he wants to pass a CR into January or April 15th, which is another magic deadline as regards to budget, in order to get that leverage for Republicans in the House to really negotiate with the Senate. This is going to be his first test. This will be key to show whether or not he can bring this conference together.
All right, Jen, thank you so much for joining us. Really appreciate getting your insight. Jennifer Flinton, head of U.S. Government Affairs for Invesco. Before joining Invesco, she spent a lot of time in Congress as working for actually Congressman Patrick McHenry in his office, so lots of experience there.
Speaker pro tem.
Speaker pro tem, yeah, absolutely. S&P 500 off 0.7%. The Nasdaq's off 1.1% here. Yields also pulling back slightly. You got the 10-year Treasury now 4.90%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. United Auto Workers have reached a tentative labor agreement with Ford Motor. We get more details from Bloomberg's Oliver Crook.
25% increase is the sort of top line on wages. Cost of living adjustment, that sort of inflation protection, that was one of the key sticking points. But then also what this means is that the Ford workers are going back to work. Where they're not going back to work is at GM and Stellantis. So the negotiation's still ongoing there. So this is the tactic often with union negotiations. They get a deal with one of them that puts pressure on the other two, and now Ford will be producing again.
Now, UAW leadership will vote on the deal October 29th. Right now, we have shares of Ford up just a fraction. General Motors right now down a fraction. Stellantis down about 1.5%. More talks are planned for today between Hollywood studio executives and leaders of SAG-AFTRA. Variety reports the studios have sweetened their offer to the striking actors, but the streaming revenue is still that sticking point. And flight attendants for Southwest Airlines will be voting on a new contract. There's a tentative agreement between the carrier and the union that represents its nearly 19,000 attendants. And the news comes as Southwest reports slowing growth plans. Bloomberg's Alexandra Semenova has that story.
Southwest Airlines, that's ticker LUV, it reported a third quarter profit that fell roughly 30%. The company blamed it on a jump in labor and fuel costs. Earnings at U.S. Airlines have been facing pressure from a surge in jet fuel prices in the third quarter, primarily driven by higher supplies of crude oil.
Now, the company also says travel demand, that's also been easing. Shares of Southwest right now, they're up just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Profits. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up to 11:22 on Wall Street. I'm Nathan Hager. A sell-off in big tech is deepening after another round of disappointing earnings is sending the stock market toward its lowest levels since May. We check the markets all day long on Bloomberg. Right now, the S&P is down 0.7%, or 29 points. The Dow is down 0.4%, or 119 points. The Nasdaq leading the declines near session lows, down 1.2%, or 154 points. 10-year Treasury is up 11/30 seconds, bringing the yield down to 4.90% of that surge in third quarter GDP, 4.9% year over year, biggest gain in nearly 2 years. 2-year is at 5.05%. NYMEX crude is down 1.7% at $83.89 per barrel. COMEX gold is down about 1/3% at $19.88 even per ounce. The euro 1.0532 against the dollar. The yen is at 150.43. The Federal Reserve says it's terminated a 2015 enforcement action against Citigroup, one of 5 banks that pleaded guilty to charges of conspiring to manipulate dollar and euro prices. Under the deal, Citigroup agreed to pay $925 million, the highest of the banks penalized. Citigroup shares right now are up 1.3%. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, very good, Nathan Hager. Thank you so much. We appreciate it. We are right smack in the middle of earnings, and it's time for the big tech companies reporting over the last couple of days. We got Amazon, I think, after the close tonight. Let's bring in some of our experts from Bloomberg Intelligence for technology, and that would be Anurag Rana. He joins us via Zoom, and Mandeep Singh, he's live here in our Bloomberg studio. Mandeep, let's start with you here. Talk to us about Meta earnings last night, and maybe you can tie it in with Google as well. But Facebook, Google, how's that digital advertising space looking?
I mean, it's looking super strong, but the problem I see, and why the stock is reacting is probably we had the best setup in terms of top line acceleration and, the cost cutting story, the year of efficiency. So really they got back to 40% margins, but this is the peak.
See, I've been using that. I've been citing him as Mandeep Singh called out peak margins.
I've heard you do it at least once in this program already.
Hey, all right, Anurag, we have you ensconced out in Chicago. I'm sure you enjoyed your commute today. You're welcome. Talk to us about what we're going to expect here from Amazon. And, to me, it's all about the boxes in front of my door, but I know for guys like you, it's all about the cloud.
Yeah, the box is going to be fine. The economy is doing okay, but the cloud numbers, we think it's going to be weak. The guidance is not going to be that strong, and largely because we heard from both Google and Microsoft that companies are still in the cost optimization mode, which is not a good sign for AWS. From Microsoft, they did get a boost on AI, but, it's going to take a while before the rest of the cloud providers get that boost, perhaps sometime next year. I think Amazon Web Services is going to be a bit weak today.
See, these tech analysts, they all think, they are great analysts in their companies and all that kind of stuff. The fact is they were born on third base. They thought they had a triple because tech spending does nothing but go up for these guys. Are you guys telling me, Mandeep, that tech spending it's not declining, but the rate of growth is slowing?
It is, and I think with cloud specifically, because of the kind of year we had with generative AI and the excitement around it, even if you beat the numbers by 1% or 2%, that's not enough because the buy-side expectations are higher, and that's where I feel these companies may not be able to live up to the expectations.
I look at the 5-year performance of all these companies. Obviously, over the last 5 years, Tesla and NVIDIA, among the big 7, have absolutely crushed it. But Amazon is the worst performer of all of them, bar Netflix.
I wouldn't have guessed that.
Bar Netflix, of the 7. Why, Anurag, has Amazon underperformed, Alphabet, Meta, Microsoft, NVIDIA, Netflix, Tesla? Why have they Tesla. Why have they underperformed everybody else in big tech?
it's unit economics. So while the cloud and everything technology is a very, very incredible business when it comes to margins, the retail business of Amazon is not like that, and it takes a lot of capital to build those logistics networks. So this is where Amazon needs to show that they can improve their margin structure when it comes to the retail business. That's the secret sauce for their valuation to go up.
Anurag, you're the Apple guy for better or worse. Is there a cloud/AI play there, or am I just focusing on when the next iPhone comes out and services?
I think it's going to be all China. I mean, none of those things will matter at this point. It's all going to be what they talk about, how demand is in China, and whether the Chinese consumer is still so much enamored with the iPhone, or are they moving to local grown phones. I think that really is the biggest story for Apple right now. If they go out and give some lukewarm comments on China, I think that's not going to be good for them. If they come out and say China is strong and we are doing well there, I think that's going to help them.
Mandeep, the advertising picture is a concern, I guess, going into a recession, obviously, but we saw, for example, Barbie only sold, sales growth was only less than 10%, and they put out a whole movie about her that was very successful.
Which I'm guessing Mandeep did not see Barbie. I'm just going to guess.
You didn't see Barbie? Seriously? You have a 3-year-old.
Yeah.
I guess that's too young. That's too young.
I'm babysitting.
To be fair. Anyway, it was pretty good. I would have thought more people would come out and buy Barbie dolls because of it, but Hot Wheels outsold Barbie. What's going on with advertising? Is it a concern?
I mean, look, digital advertising has been strong this year, and that's why, when you look at the e-commerce spend on digital ads, it's high. Meta called out Chinese advertisers being some of the biggest spenders on their platform. So all that is good news. That was incorporated in the quarter. The question is, how does it look like 2 quarters from now when the comps start to get tougher? This was the year of easy comps. Remember, these companies had really bad quarters last year. And so this was the year of easy comps. They got through that, accelerating growth. Next year, things don't look good. And the market will always look ahead. So that is a concern.
Anurag, did you see Barbie?
No.
Wait, Paul, did you see it?
No.
I'm the only person among these 4 dudes who has seen Barbie.
Yes.
You guys should go watch it.
Maybe. Well, I don't know. Anurag, let's get back to some serious stuff here. AI was the driver of all stock market activity for that first 6-7 months of this year. I don't hear as much about it now. Is it played out, or are we just not paying attention anymore?
Oh, no, wait till the summer of next year. We're all going to talk about it again, because right now we're just looking at the building blocks. The NVIDIA numbers, the Dell numbers in terms of the AI servers. You're looking at Oracle's backlog of that. You look at Microsoft's 3% bump in AI. It's just, the movement has just started. It's going to take a few quarters to a few years to build out, but this is going to be one of the biggest drivers of tech spending over the next 3 to 5 years.
Is Google going to make some real moves forward? Because they seem to be lagging behind in both AI and cloud.
Yeah, they're going to be fine. I wasn't sure if you were asking me or Mandeep.
But I mean, look, Google has already released 2 of their own large language models to compete with OpenAI, ChatGPT. And they're providing the cloud for companies to train their own models. So there's no way anybody can say they are behind. Maybe, when ChatGPT was initially released, that was a threat, but they have definitely offset that.
I mean, ChatGPT is the only one that anybody in the country's ever heard of, right?
Let me tell you how big this is. On, when is it? November 8th, Bloomberg Intelligence is going to be hosting an investor conference in New York, exploring generative AI's disruptive promise. Now, aside from a very weak opening remarks person, you guys have a great lineup
Who's
here.
Who's giving the opening remarks?
Some guy, I don't know, some management type, some suit. Tell us about this conference here. What you got going on?
Yeah, we're just trying to put together all the pieces of Gen AI in half-a-day conference, from training to inference. We've got executives from Meta, Amazon Web Services, and also pure play companies like Runway, which trains video LLMs. So anybody who wants to understand what are the building blocks of generative AI, this is a great event. And it's just half a day.
All right, what jumps out at me is the networking cocktail reception at 5:30. I think I'll make a presence there.
I want to understand
Yeah, so that's good. I mean, it just goes to show. I mean, it kind of.
Are you going to broadcast from that conference, Paul?
We might have to tie something in with these BI guys, but it just kind of goes to that whole generative AI thing, and it's just investor interest in it, right? That's kind of the way to think about it, Mandeep. The investor interest is big, and I know you guys have written a lot on it.
Yeah, the pure play companies, Runway, Hugging Face, Scale AI, these are the names that are not household names, but they have got a sizable valuation in the private market.
And Anurag, just real quickly, 30 seconds, Microsoft, is that kind of a way for somebody like me, if I want to get exposure to AI?
I think the entire tech basket is going to benefit. It's a question of who benefits when. So, currently Microsoft has publicized it a lot more, but when you look at the software world, Adobe is very well positioned. There is no reason why they won't benefit. In the long run, all the large companies will benefit as well. So there is no shortage of companies that will see downstream work because of AI. Right now, the only household name is NVIDIA and, for that some matter, Microsoft.
All right, that's awesome stuff. Anurag Rana, Mandeep Singh, they're senior tech analysts of Bloomberg Intelligence. They got a pretty cool investor conference coming up November 8th afternoon. Bloomberg HQ, 731 Lexington Avenue.
Oh, cool, it's here.
Check that out. Yeah,
nice.
It's here. So if you're, a client of Bloomberg, you can go register for that and learn all you need to learn about generative AI, which, come on, it's just tech for me. I don't know, big deal. S&P 500 off 0.75%, and NASDAQ off about 1.3%. Let's get some news now. Down in Washington, D.C., Amy Morris.
All right, thank you, Paul. The White House has ordered all U.S. flags to be flown at half-staff. President Biden is urging Congress to pass an assault weapons ban bill, and Maine State Police say an arrest warrant is issued for the suspect, Robert Card, for 8 counts of murder, 10 more victims who are unidentified. Maine Department of Public Safety Commissioner Michael Sosjug.
Card is considered armed and dangerous. He is a person of interest, however, and that's what we'll label him at moving forward until that changes. If people see him, they should not approach Card or make contact with him in any way.
Hundreds of police are searching for Card. They say he went on a shooting spree last night at a bar and a bowling alley in the town of Lewiston, Maine. The prosecution has arrested an FTX founder. Sam Bankman-Fried is expected to testify in his own defense at his criminal fraud trial in Manhattan. The 31-year-old cryptocurrency mogul is accused of stealing as much as $10 billion in deposits from FTX customers. Bloomberg's Shonali Bassick is covering that trial.
We expect him to follow up on what the defense has put forward, which is this idea that Alameda, the hedge fund that he founded and once ran, had taken money from FTX by means of margin loans, and that this was a matter of poor risk management and not intent to commit fraud.
Bankman-Fried faces more than 100 years in prison if convicted on all counts. The United Auto Workers have reached a tentative labor agreement with Ford, with UAW leadership is set to vote on this on Sunday. Those details from Bloomberg's Oliver Crook.
The top line is 25% increase. There's also this cost of living allowance, which was sort of inflation protection for paychecks. And it means that the workers at Ford are going back to work. And that is a deliberate part of this strategy to put additional pressure on Stellantis and GM.
Bloomberg's Oliver Crook speaking on Bloomberg Daybreak. Listen for that full interview wherever you get your podcasts. Global news 24 hours a day and whenever you want it with Bloomberg News Now. This is Bloomberg.
Profits. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 11:40 on Wall Street. I'm Nathan Hager. Stocks are close to session lows. The S&P 500 is edging toward correction territory, with companies missing on earnings getting punished, led by big tech. The disappointing outlook on advertising growth from Meta Platforms still has that stock down 3.8%. But Franklin Templeton portfolio manager Katrina Dudley sees reason for optimism even in this sell-off.
Jobless claims continue to come out, and they're continuing to be positive and surprising you. So we're all focusing on the negatives. Companies are all cautious, and they're almost being told, don't be the optimist in the room. And as an investor, that's when you make money.
Well, we check the markets all day long here on Bloomberg, and right now the S&P 500 is down 0.7%, down 30 points. 4156 is the S&P level. The Dow is down 0.33%, or 116 points. The NASDAQ leading the declines, down 1.3%, or 168 points. 10-year Treasuries up 12.30 seconds. The yield 4.90%. The 2-year yield is at 5.06% now, a drop of 6 basis points following a surge in third quarter GDP. NYMEX crude is down 1.8%, down $1.50 at $83.90 per barrel. COMEX gold down about 0.4% at $19.88 even per ounce. The euro is at 1.0527 against the dollar. The yen 150.47. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, here's some economics for you. We had the GDP print today, Matt, right? 4.9%. Things
Strong.
are great. Yeah. But then you go look ahead, and you see a company like United Parcel Service. These folks, they see the economy every single day on the ground. They put up disappointing numbers, cut the forecast again. To me, that's the number to be focused on.
I mean, you don't even have to look ahead, right? They did cut their outlook for the second time in less than 3 months. But even backward looking, it was horrible. Annual EPS came in at $1.57, down 47% from a year ago.
Well, they got to pay their pilots more now, right? Didn't they have that new contract?
I don't know.
Let's bring in somebody who knows about this stuff. Lee Klaskow, he covers all the transportation stuff. We blamed him for the supply chain thing back a couple of years ago. Now he's fixed that. Yeah. He's with Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio. Hey, Lee, what did you really hear from UPS and their earnings and kind of their outlook?
Well, I mean, at the end of the day, they had a tough slog with their labor negotiation. They lost a lot of business to FedEx and other carriers. They're in the process of winning that business back. They've won probably around 600,000 packages per day back what they lost. And it's going to take some time for them to get it all back. The good news is that some of the sequential changes that they saw from August to October, which August was the hardest hit from that labor agreement in terms of volumes going away, they're seeing seasonal trends well above what they normally see. They said that volume during that time period sequentially was up around 2.7 million packages a day. And last year that was around 1.5 million packages a day. So it's definitely, they're definitely turning in the right direction, but the streets got to readjust their models. Fourth quarter expectations are definitely going to have to come in. They provide full year guidance, which, as you mentioned, they had to lower it again. But when you look at the implied, what that means for the fourth quarter earnings expectations and the EPS basis are going to have to come down anywhere between 25 and 30 cents.
Well, you care about UPS for the sake of UPS and their competition. We care about it mostly, I would say, for their view on the economy, right? Because if things are going well, we're going to be shipping packages back and forth. If they're losing out to competitors, that's one thing. But if they have a dour outlook because they expect the economy to slow, that's another. Which is it?
Yeah, I think, UPS is obviously a bellwether for the global economy. They have businesses everywhere around the world. They ship everything you can imagine and probably things you can't imagine. But I think
I would love to hear the top 10 craziest things UPS shipped.
Yeah.
Why don't we do a top 10 list ever, Paul?
Yeah, that's a good idea.
We should.
That hasn't been done before.
Yeah. Well,
Okay.
I mean,
Anyhow,
I think the weakness that you're seeing in the fourth quarter, about a third of it is probably macro driven, and 2/3 of it is UPS specific.
Excellent. That's exactly what I was wondering. So 2/3 of it is company specific or industry specific, and a third of it is the economy.
Yeah, because I mean they're really dealing with the lost share that they had, and when you have these huge networks, there's a deleveraging effect, right? So the less density you have, the more expensive it is per package.
So how do you win back business? Just on price?
Price, service. The company during their call was very adamant about the fact that they are not using price to entice people back. Maybe they're giving a slight discount, but they're not going into a deep discount, because at the end of the day, they have to pay for that new labor agreement. It's a 5-year deal. A lot of it it's front loaded. Something like 48% of it is in the first year. So they need to really offset that cost, and that's going to be a headwind for them going through the first half of next year.
How does their labor cost look compared to others? And the reason I'm asking is, you mentioned service, right? They're going to deliver better service if their employees are better paid and in less stressful working conditions, have air conditioning in their trucks or heating in the winter. Are they in a good setup in that way?
When you look at UPS and you look at FedEx, there are two different models. FedEx has the independent contractor model. Even if you look at Amazon has an independent contract model. What it benefits UPS is they have stability in their workforce. They have a place where people probably want to come because they're making more. And not only maybe they're not making so much more from a dollar standpoint, but when it's all said and done, benefits, pension, all that stuff, it's a place where people not only want to work, but they probably want to work their whole careers, versus a FedEx or an Amazon, where the employees are it's really a transaction, if you will. They're just there for the paycheck, and if they find something better, they're off to the highest bidder.
To me, that would, as a customer, I would rather than use UPS.
Yeah, you get a relationship with your delivery guy.
Exactly.
Or gal. Yeah.
And they have a cool uniform.
Yeah.
I like the brown.
So are we going to put air conditioning in the trucks now?
They're putting the fans, air conditioning, all that sort of stuff.
Why didn't they in the past?
They just, you've seen them on the road. They
just
open the doors, and listen, it's at the end of the day.
These guys are down in Texas where it's like 300 degrees out. I mean, I don't care how many doors
now they're changing it.
They're changing.
They
They're
didn't
evolving.
expect global warming to happen like this. Nobody told them it was going to happen like this. Who knew?
Exactly. All right, Lee, let's step back a little bit from UPS, just kind of your space in general. You do, the big ocean shipping containers, the railroads, the trucks, everything in between. Talk to us about just how is it out there in the transportation space? Are your companies seeing a slowdown, and if so, how pronounced?
Well, we've been in a freight recession for over a year now.
Now, was it just tough comps?
Tough comps. There were certain aspects of the market that were down a lot more. What we're seeing now is that the freight recovery will probably lead the economic recovery, and the freight recession should probably come near to an end in the first quarter because of easier comps.
Okay.
Assuming we have some sort of GDP growth. It doesn't have to be stellar growth. It could be low single-digit growth. Assuming that's the case, we should come out of this funk. And what this done is really depressed rates across the board. So if you're looking at trucking rates, liner rates, they are very, 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 very low. And it's, for some of these markets, especially trucking and the container liner market, it's really hard to figure out what's going to bring rates up because there's a lot of downward pressure because there's just so much supply out there.
Why is there supply?
Well, on the ocean liner.
Oh, okay.
On the ocean
everybody
liner
wanted
aspect,
capacity, right? Everybody expanded.
People are buying capacity. Capacity growth is expected to outpace demand growth by something like 500 to 600 basis points this year and next year. And then you have rates that were, they're down for like 70% from a year ago.
Now, if you wanted to ship your car now.
Now's the time.
No problem.
Now, yeah, but I had to sell it.
Yes,
it's
exactly.
a horrible. It's a depressing story.
And if you wait, if you want to wait, you probably get an even better rate because liner rates. There's really no net for liner rates right now. Wow. Trucking is a different story. Supply is coming out of the market, which should bode well for truck rates.
All right, Lee, great stuff as always. Lee Klaskow, he is a senior transportation analyst, logistics, all that good stuff for Bloomberg Intelligence, based down in Princeton University, but making his way here to New York. We appreciate that. We're going to have more coming up. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paul. Merck has raised its sales forecast thanks in part to increased demand for its cancer drug Keytruda. Bloomberg's Alexandra Semenova has details.
Total annual sales are now expected to be as high as $60.2 billion. That's up from its prior guidance. And Merck has been riding the fortunes of Keytruda, which accounts for about 40% of its revenue. The company basically needs to make as much money as it can from the drug over the next few years before it faces generic competition and U.S. government price negotiations.
Now, another bright spot for the drug maker, the controversial COVID treatment pill, Legevro. Now, Merck shares right now, they are up about 3%. And Amazon is the next so-called Magnificent Seven technology company to report earnings. Bloomberg Intelligence senior technology analyst Mandeep Singh has a preview.
The retail business, we know, has come up very strongly, even though 2020 was a bad year. But e-commerce has rebounded very well this year for the 3 quarters that we have seen. And so retail business doing well. Amazon Web Services, we know expectations have come down a lot.
Amazon relies on AWS for about 17% of sales and nearly 3/4 of its $7.7 billion in operating profit in the second quarter. Shares right now of Amazon are down about 1%. And Apple is planning a big overhaul for one of its best-selling products. Yes, its AirPods are getting a makeover. Apple will revamp their design, the look of the cases, and upgrade the audio quality. It'll start with the Max AirPods next year and a new Pro model in 2025. Shares right now are down about 2%. Those are the company stories we're following. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets right here, we have red on the screen here. S&P 500 off about 0.75%. The Nasdaq seeing the pain there, off 1.3%. Yields pulling back as well. The 10-year Treasury off about 6 basis points. Let's call it 4.89% on the 10-year. And looking at WTI crude oil, another pullback, 1.5% decline, $84 on WTI crude oil. It did get below 83 here earlier today in the trading. Bitcoin, I'm calling that out. That's down 1.9%, sitting right at $34,000 per token. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
Thank you, Paul. Republicans have turned to a little-known lawmaker to be the newest House Speaker, Bloomberg government's Jack Fitzpatrick, with more on Congressman Mike Johnson of Louisiana.
He's not somebody affiliated with old leadership teams, which was something that held Steve Scalise back. He's not somebody who made a lot of enemies among House Republicans, which is something that held Jim Jordan back. He's got a record. It's a very conservative record, but he's also somebody who's seen as a fresh face among House Republicans.
Bloomberg government Congress reporter Jack Fitzpatrick in Washington. Donald Trump is taking credit for Johnson's speakership. Israel said it made limited ground raids against Hamas targets in northern Gaza overnight before withdrawing. Those details now with Bloomberg's Galit Alstein in Tel Aviv.
The IDF confirms today that their number is 224. That's the number of hostages that are now being held at Gaza. We have no indication that this is in fact moving forward, other than what we heard yesterday from the Qatari foreign minister, who said there is a chance of a breakthrough soon, but we do not know yet what this breakthrough means.
Bloomberg Israel government and economy reporter Galit Alstein in Tel Aviv. Something to consider as you tune into the World Series. Is your hometown one of America's baseball cities? Bloomberg's Michael Barr reports.
Wallet Hub listed the best cities for baseball in America. Number 1.
A Judgian blast to deep right center field.
New York, Los Angeles, and St. Louis round out the top 3. Atlanta, Boston, Chicago, and Cleveland are also in the top 10. The rankings were based on things from ticket prices to the number of games the home team has won and the club's minor league. College teams also played a role in the rankings. In New York, Michael Barr, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right, Amy Morris, thank you very much. We appreciate it. Walt Disney Company raked in theme park revenue last year, boosted by a strategy that puts a price tag on everything, from dinner with Cinderella and lightsaber workshops to skipping the line to join the Guardians of the Galaxy. Think about these numbers. A deluxe vacation at Disney can cost over $40,000. That's with all the frills, a 6-night Disney resort stay.
I can make it cost $400,000, but you know, this is like Brewster's Million spending.
It is unbelievable.
$26,000 for the hotel, Grand Floridian. That's level 2, 2-bedroom suite. Obviously, if you get a 2-bedroom suite, it's going to be expensive.
Well, you got a big family. You're going down there. You want the VIP tour to skip all the lines.
$6,300. $6,300 is one day skip all the lines VIP tour.
Wow, it is just
Who's going to buy that?
Now, here's the thing from the consumer perspective, it's absolutely crazy, the numbers. But, and I am not a Disney person, but I know very well a Disney freak, and they are crazy people. They are so loyal to this Disney thing. And they're old enough to know better, by the way, but they're still into it. So I think Disney's realized they can charge pretty much whatever they want. And quite frankly, if you're the Disney company, it's your best business.
$1,000, build your own lightsaber for $4.
Sure.
That sounds worth it. Now we're talking about something that I get, you know?
Exactly. I mean,
what about the Bibbidi Bobbidi Boutique Princess Makeover?
Well, we can do that.
Would
for
you
Edna.
go for that?
We can do that for Edna.
Edna, for sure.
Yes.
I just wonder if they would let me do it.
And Disney just said they're going to double their CapEx to $60 billion over the next 10 years on their parks, resorts, and theme, and their cruise businesses. So that's where the money is. It's not in ESPN anymore. It might not even be in the whole movie, TV production business, which they dominate. The future here, from a profit perspective, from an investment perspective, is the theme park business. And why not $40,000 for a 6-night stay, going all in?
I could do it for $4.
Top. You can do it for $4. Well, more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up, I think this is going to be the discussion of the day. I'm fascinated with this story. Max Chaffin's going to join us. He's a columnist of Bloomberg Business Week to discuss Sam Bankman-Fried's testifying in his FTX fraud trial. Man, I would love to be a fly on the wall to watch that testimony. So we'll get Max's reporting there. Plus, Lisa Sturdivant, chief economist at Bright MLS. She's going to join us to discuss this week's real estate data. I mean, we got a 30-year fixed mortgage at over 8%. I'm not sure who's buying homes right now, except our next guest, Bailey Lipschultz. He covers all the markets for Bloomberg News. Terrible timing as it relates to getting a mortgage.
You can't time these things. You know, if you're in a lifestyle situation where you need to
get a crib, you go to
move
Jersey.
to the suburbs.
You go to the burbs. You go
gotta
to Jersey.
pull the trigger when you need to.
Billy, what do you got for us in those markets?
A lot of red, and I will say when you're renting in Hoboken and they hit you with a 23% rate increase.
So we'll go to that. All right, let's start this whole hour off with Charlie Pellet.
Hi, thank you very much. And here's what's going on. Bailey will have a whole lot more on the markets as we dig deeper for you. Coming up with a lot of moving parts today. GDP, the ECB, and after the bell, Amazon.com. Right now, lower across the board. The slide in big tech sent the stock market toward its lowest since May. And another round of disappointing earnings. Not even a slide in bond yields is able to bolster the industry that has driven this year's rally. S&P right now down 31 points, a drop now of 0.8%. We have got the Dow lower by 125 points, down 0.4%, while NASDAQ is down 176. That is a decline of 1.4%. 10-year yield 4.89%, with a 2-year right now 5.04%. Gold little changed, up less than 0.1% right now, up 75 cents to $19.80 the ounce. West Texas Intermediate crude 84.15 a barrel, down now by 1.5%. Meta platform shares are sliding the most in almost 11 months, down 3.3%, following executive comments warning of softer advertising spending, and that put a damper on an otherwise upbeat earnings report. Mandeep Singh covers technology for Bloomberg Intelligence, and he was a guest this morning on surveillance.
Last night, actually, they had a very strong quarter. Everything looked great from a margin perspective. They're back to 40% operating margin, which we're used to seeing with Meta. The only thing was the guidance range was pretty wide, the 13 to 24%, and they added the word uncertainty a couple of times on the call, and they kept saying, Reality Lab losses will keep going up.
Reality Labs is the metaverse division of Meta's business. And by the way, you can hear more of that conversation on the Surveillance podcast. Meta shares down now by 3.4%. Amazon, after the bell, down now by 1.3%. Again, recapping, stocks lower. S&P down 33, a drop there of 0.8%. Our Bailey Lipschultz got a lot more of the markets coming up. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Matt Miller and Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Red on the screen as Charlie was just reporting there. Billy Lipschultz, he covers all the markets for us. He joins us live here in our Bloomberg Interactive Broker Studio. Billy, what are you looking at today? Lots of earnings out there, I guess.
A lot of earnings, a lot of underwhelming guidance being provided by management teams. Worst performers in the S&P 500. Invisalign maker Align Technology, ticker ALGN, down 25%. Whirlpool, ticker WHR, maker of Maytag products at Homes down 17% after missing expectations, and Hasbro down 11%, ticker HAS. That's on top of Western Digital, ticker WDC, right now down about 11%. That coming after deal negotiations with Kioxia broke down, squashing hopes for a combination of their flash memory businesses. So underwhelming earnings from a number of companies across the spectrum, paired with lackluster guidance from Meta, which is underperforming, all ahead of Amazon, which will be the big one after the bell today.
And we were just talking to Lee Klaskow from Bloomberg Intelligence about the UPS numbers. I mean, when they say economy's slowing, or maybe our traffic is slowing down a little bit, boy, that gets your attention.
Well, it's so interesting, right? When you compare some of the economic data, the consumer spending data we've been seeing, the consumer seems very strong, but you're getting these warnings from companies, as you mentioned, UPS cutting forecast again, that coming after the new labor deal hitting profits. You do see kind of uncertainty continuing to bubble up. We have the NASDAQ 100 down just over 10% from its July highs. So you're dealing with potential correction territory, underwhelming earnings, again, from Invisalign maker, toy makers, Meta Platforms talking down expectations for 2024, uncertainty. A lot is going on to the downside, and that just continues to be weighing on investor risk appetite.
Do you see these companies getting hit harder for missing than they are rewarded for beating?
Without looking at the data, I would say so. And the big focus is obvious. Investors want to look forward. So forward-looking, we've seen a number of companies beating on 3Q. That's what Meta did. But when you talk down or miss on 4Q and then talk about how 2024 is uncertain and you don't really know where your business is going to be, that's why you're seeing sharp moves. But again, context is everything, as Paul will point out. Meta's still up 140% this year. NVIDIA is still up 178%. So some of these are your best performing Magnificent Seven stocks that on a day-to-day basis looks kind of ugly, but when you step back and look year to date, pretty strong.
When you look at the data, do you use EA Go on the terminal?
I don't.
I see. Well, I'm looking at the S&P. EA Go is a great way to pull up earnings analysis. Sales surprise, we've beaten about 1%. Earnings are beating by about 8%, but we've only had 208 of the total 500 companies in the S&P report so far. That's in terms of beating expectations. In terms of earnings growth from these companies, we've seen 11% earnings growth and more than 4% sales growth. So it's pretty incredible. But most of that has come from Paul Sweeney's communications group. They're up 36% in terms of earnings growth, 6 1/3 in terms of sales growth.
Look at you with your EA functionality. He's all over it. Anything else there, Bailey?
MasterCard under pressure right now, down 5.3%. That coming, again, after earnings revenue outlook, missing analyst expectations most in a year on that drop.
All right, very good. Billy Lipschultz, thanks so much for joining us. Appreciate that, as always. I tell you, here's the story that's got my attention over the past couple of days. This is going to be fascinating. Sam Bankman-Fried, he's going to testify in his trial on his own behalf to try to, I guess, counteract some of the negative testimony from some of his former colleagues and friends and girlfriends. I don't know what's going on there, but Max Chafkin, he knows. He's a columnist for Bloomberg Businessweek. Max, this sounds really risky from my perspective. What do you make of it?
Well, so, you know, as you say, and as you're hinting at, criminal defense attorneys generally do not advise their clients to testify in their own defense, especially in a case like this. Sam Bankman-Fried, though, is not a traditional client. And as we know, anyone who's followed this story knows that he spent a lot of the weeks after the fall of FTX, and even after his own arrest, giving interviews, talking to pretty much anyone under the sun, saying all kinds of sort of half-cocked, probably legally ill-advised things, including that he, effed up. And I'm quoting there. And so again, this is not a traditional client, and we're probably not going to see a traditional defense or traditional testimony from him.
What have we seen so far? I mean, has the testimony been so damning that putting himself on the stand, or that a lawyer putting him on the stand, is the best the defense team can do?
I mean, I think, again, I'm not on the jury, and so it's always hard to speculate, but it has seemed from the outside to be pretty damning. I mean, we've seen basically his closest friends and senior executive team all get up there on the stand and talk, not just in detail saying that, yes, the crimes that that the state is charging did occur, Sam Bankman-Fried did them, but producing essentially mountains of evidence showing Bankman-Fried's direct involvement. So we've seen messages, we've seen Google Docs, we've seen these very specific accounts, particularly from Caroline Ellison, who was the CEO of Alameda Research, that was Bankman-Fried's hedge fund, and his ex-girlfriend. They produced this kind of chain of balance sheets that Sam Bankman-Fried was very active in. So, it has not looked good for the defense.
What has been his, I guess, defense in this? What's he claiming, or I don't know.
Well, he already told us he effed up.
There are aspects of the defense that look like a traditional white-collar defense. A lot of times in white-collar defenses, what the person who's accused will try to do is present as very complicated. There's a lot of ins, a lot of outs. This is, complicated stuff, and I was doing my best, didn't mean to commit fraud. There is some of that here, but there's also been an effort to essentially blame everybody other than him. And that's the part that I'd say is probably legally, less well advised. He spent a lot of time in interviews ahead of this, and we've seen some of this come out during the trial, essentially blaming Caroline Ellison for the fraud, or blaming his lawyers, or blaming outside counsel, and so on. And again, it hasn't seemed especially credible because the prosecutors have been able to produce emails and so on showing that he was very involved. And also, it's not exactly a good look when the CEO is saying, oh, no, this is just my underling's fault, especially the CEO who at one time, had personally enriched himself to the extent that Sam Bankman-Fried had done so. We've learned of $1 billion in personal loans, $300 million in luxury real estate, and the list kind of goes on and on.
Is there any chance, and I don't know that this matters in terms of this current court decision, but is there a chance that people who lost money in FTX are made whole because of moonshot investments that they made that now look like they may pay off?
Yeah, I think it's definitely too soon to say made whole. I think it's looking increasingly likely that some money at least will be recovered. I think you're alluding to Anthropic, which was this kind of moonshot AI investment. There's now there are rumors, valuations being tossed around in the tens of billions of dollars. The issue is that there's a lot of these assets are not highly traded. So it's sort of hard to know, like, if they started selling them, what would happen to the price, where would they go? And even with a case of Anthropic, right, you can't just go and sell that stake on the open market. A lot of this stuff will take a long time to unwind. The economy can change, and so on. The other thing is, the question of whether or not investors can be made whole isn't really relevant to Sam Bankman-Fried.
It's not relevant, but yeah. Matt Levine has written about if you defraud somebody and that person never gets her money back, you're going to be in trouble. But if you defraud someone and she does get her money back, it's going to be less bad, right?
Yeah, and perhaps that'll impact how Sam Bankman-Fried's legacy is perceived and so on. I don't think it's going to have an impact on this case because, again, the jury isn't hearing this stuff. And again, the charges are, did Sam Bankman-Fried take customer money and gamble it? The fact that you gambled it and maybe won doesn't necessarily, address the central allegation. And again, there are other allegations here. We're going to have a second trial around campaign finance violations. That stuff can, he could go to jail for a long time. There's the Chinese bribery allegation. So there's a bunch of...
These are separate trials?
There are two separate trials, yes.
So what's the timeline look like for this one?
So we're going to see Bankman-Fried likely start testifying today. That'll go into tomorrow, probably early next week. The jury could begin deliberating next week. We could have a verdict as early as next week, although it seems possible it could go on to the...
Are reporters allowed in the courtroom?
Yes.
Okay.
The public is allowed in the courtroom. We have a team of people down there. They've been reporting on this, relentlessly. You can read it on Bloomberg.com at the terminal. General public's also in there. So we've seen kind of a weird rotating list of kind of crypto figures and influencers. I think Martin Shkreli was down there early on. It's sort of been a kind of weird reality show.
Because this really, to a certain extent, I wonder, crypto, is this to what extent is this an indictment or of the crypto space? Is it seen that way by people?
Well, I think it depends who you talk to. So you talk to people in the industry, right? They have been very keen, and you've seen the industry really, they have been some of the most aggressive people in calling out Sam Bankman-Fried because they want to make an effort to say, hey, look, this was a bad actor, bad apple, he's making us look bad. I think in the minds of normal investors, in the minds of the public, right, that argument's a little harder because Sam Bankman-Fried, his whole thing was that he was the most law-abiding, least sketchy. I mean, this is a world that has operated kind of on the edges of various laws in all over the world. So again, I think it's really too early to know what the impact is going to be on crypto broadly. And I think some of that has to do with, frankly, the verdict. And depending on what the jury says, I think will affect how people process this.
Dude, you got to think that, just because Bernie Madoff committed a big $65 billion fraud with an investment Ponzi scheme, that's not an indictment of the U.S. stock market and certainly not of the U.S. dollar, right?
Right, exactly.
Although I could see that because crypto is so difficult to understand and because it's not clear yet whether much or even any of these coins are going to be worth something in 5 or 10 years, people might very easily conflate the two.
Yeah, absolutely. I mean, it was an indictment of Ponzi schemes, right? And the crypto critics are gonna essentially say that there are businesses out there that are operating in ways that aren't necessarily that different from the way FTX was operating.
And this guy's facing real jail time, right? What is it?
I mean, he faces a potential life sentence.
Wow.
Effective life sentence.
Yes.
It's going to be so many years that it would be, he would be old or deceased by the time he got out. We don't really know. Of course, there's a wide potential range of potential sentences. You're talking about anywhere from years to decades, and of course he could be acquitted. Whatever happens with this case, I think there are definitely going to be appeals, and there is this second trial, the second criminal trial, which also carries significant jail time.
All right, man, great stuff, Max. Thanks for joining us here, Max Chafkin. He's a columnist for Bloomberg Business Week, with continued reporting from the Bloomberg team, as Mac was telling us about the Sam Bankman-Fried. I mean, this is just an extraordinary trial, just because it's just a financial crimes that always gets folks interested, and then it
certainly here at
includes
Bloomberg,
crypto, certainly here at Bloomberg, and then it's an eccentric guy, and this guy's Sam Bankman-Fried.
Yeah, checks every box for us for sure, and it'll be interesting to see, what happens beyond this. As Max said, there's another trial. A lot of people are talking about the culpability of others in Sam Bankman-Fried's very close familial circle. Do you feel sorry for him? I mean, let's say he gets busted, he's guilty, and they put him in jail for like 30 years. This kid's only like 30 years old.
Yeah, I mean, if there was proven intent, then no. If it's actually true what he's saying, which is, hey, I didn't have any bad intent, I just kind of got away from me and blah, 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 well, then I might have a little bit. But if it's proven that he had intent, he knew what he was doing, then zero.
I gotta say, I'm a bit of a softie when it comes to these white-collar crimes. Even if someone is guilty with intent, I still feel bad for people that have to go to prison for decades, especially if it's
not good. No
like
bueno.
a bad prison.
Yeah.
I'm not talking about Martha Stewart, like a federal pen where you have tennis courts. But,
even in hindsight, that one was terrible in my mind. She shouldn't have gone to prison. I don't know, but who knows? But we'll see here. And this one looks like some. As Max was suggesting, and some of the reporting has stated, there could be some serious criminal time associated with that one. So again, stick with Bloomberg. We're all over that stuff. S&P 500, it's off 1.1%, so we're plumbing some of the lows of the day. NASDAQ off 1.8%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Theme parks and broadband, well, they're boding well for Comcast. The company reported higher earnings even as it lost 490,000 cable TV customers in the quarter. Now, executives are switching the focus to other businesses. That includes Universal Theme Parks and Film Studio and the Peacock streaming service. Now, as for broadband, Comcast lost 18,000 broadband subscribers in the quarter, but its revenue per customer, that climbed. Shares right now, though, down more than 6%. And the wild success of the Barbie movie proved profitable for Mattel, but not enough to make big changes. Bloomberg's Gina Cervetti explains.
Shoppers snapped up Barbie dolls and Hot Wheels cars in the latest quarter, but Mattel stuck with its full-year sales outlook because of softness in the industry overall and a weaker global economy. Since its July release, the Barbie movie has generated more than $1.4 billion in global ticket sales, the highest-grossing film of the year.
Shares right now, they're down about 8%. And Hasbro didn't have much luck with toy sales slumping. The company missed third quarter profit and revenue expectations and slashed its full-year outlook. Hasbro shares right now, they're down about 11%. And the United Parcel Service lowered its annual profit target due to a spike in costs from a new union labor contract and also weaker package demand. Now, its CEO did say that volume diverted during those labor negotiations is starting to return. Now, to help shore up profits, UPS is focusing on healthcare and small business deliveries that typically fetch higher prices. It's also pledged to cut 2,500 management jobs and lean on automation. Shares right now, they're down about 5.5%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We are at the lows of the session right now, with the S&P down 49